Kevin, do you want me to bring in the judges or what would you?
Yeah, we'll bring everyone in at like let's say 9:57.
Okay, even the judges, right?
Judges, participants, yeah.
Okay.
Um, and then I'm gonna speak at 10 for th 3 minutes roughly, probably 2 minutes, and then
Hmm.
I'll hand it off to team one.
Oh, by the way, we're showing up on the live stream.
Thank you for letting me know. All right, it's about 1 minute early, but we're going to get started here. Good morning, everyone, and welcome to the final round of BV Challenge 2025. For those who don't know me yet, I'm Kevin Flother, the person who participants have likely seen in their inbox or on Zoom over the past couple of weeks. I lead our marketing efforts at CBV Institute, and this event has been close to my heart since its inception 4 years ago. It's really amazing to see how far it's come in that short time. Yesterday, we saw some truly outstanding work from participants. Teams from universities and colleges across Canada took on a complex valuation case, and they applied analytical rigor, teamwork, and creative thinking. And these are some of the very qualities that define the chartered business valuator profession. Today, the top 6 teams seen on the screen will take the virtual stage to present their final cases before a panel of judges. These judges are all experienced CBVs and industry leaders who know firsthand what excellence in valuation looks like. Judges, in between each presentation, you will be moved to a breakout room to deliberate. So please don't begin until that happens. Before we begin, I want to take a moment to thank the organizations who made this event possible. Since the first year of this event, title sponsors KPMG and OMERS have provided exceptional support and leadership in helping us deliver this national case competition. We're also grateful to our event sponsors, Davis Martindale, Kalos LLP, and MNP, for their commitment to advancing business valuation education among business school students across the country. And finally, a big thank you to our supporting sponsors, the Financial Modeling Institute and PwC Canada, for their contributions. Additionally, this year's challenge marks the launch of a new partnership with Deloitte. Thanks to this collaboration, all members of the top 6 teams, so those presenting today, will be invited to interview for a Deloitte scholarship. This scholarship includes a $4,000 award towards schooling, a regional internship, and paid registration in level 1 of the CBV program of studies. To all our finalists, congratulations on making it this far. You've already demonstrated the skill and drive it takes to succeed in this field. And to everyone watching, thank you for joining us to celebrate the next generation of valuation professionals. Good luck to all teams, and let's begin the finals. With that, Team 1, you may begin to share your screen and start your presentation when you are ready. I'll hand it over to you folks now.
All right, pleasure to meet you all. We're excited to begin this year's BV Challenge Finals, and I suppose without further ado, we'll get started on our presentation. Well, yep, good morning again, and I hope you're all having an excellent day and excellent morning. My name is Cedric.
I'm Leah.
I'm Muskan.
And I'm Sabrina.
And together, we're Team 1 of this year's BV Challenge, and we're excited to start off the finals by presenting our evaluation and analysis for Crescent Oak Partners, navigating a potential reverse takeover, buyout, and recapitalization, followed by a comprehensive recommendation to maximize FMV per share. First, we'll begin with an overview of Crescent Oak's operations and objectives, followed by a summary of its strategic options and its recapitalization alternative. Then, we'll dive into our valuation approach and qualitative drivers for both Option 1, a proposed merger, as well as Option 2, a structured buyout offer. Then, we'll dive into operational implications of a share recapitalization and its potential impact upon dividends. Finally, we'll compare our FMV results to suggest an optimal decision for Crescent Oak Special Committee, backed by our strategic recommendation.
Let me start with a quick snapshot of Crescent Oak Partners. The company operates through 2 divisions, capital markets and wealth management. The capital markets division focuses on IPO advisory and investment banking, but is highly cyclical and has been significantly impacted by the recent economic downturn. This resulted in negative earnings of about $4.5 million, suspension of dividends in fiscal year 2025, and a sharp share price decline of roughly 60% from $55 to $20. On the other hand, the wealth management division provides stable, recurring revenue through investment services, but overall liquidity constraints and high leverage remain challenges. Against this backdrop, the special committee engaged us to evaluate strategic alternatives that could restore investor confidence and maximize shareholder value. Based on our analysis, our final recommendation is to pursue a merger with Pinnacle Wealth. I'll highlight the three options we assessed before moving into the evaluation work. The first option, merger with Pinnacle Wealth, which is also a recommendation. This involves a reverse takeover, giving Crescent Oak shareholders 36.5% ownership in the new public entity, NewCo. Key benefits include liquidity relief and synergies, while risks and challenges center on integration and reduced control. Option 2 is a management buyout, a $45 per share offer with an immediate premium, but it carries financing uncertainty and deferred payments. Our last option is share recapitalization. Crescent Oak can choose to issue new shares at $18 per share, a 10% discount, to improve leverage and retain control, though it brings dilution and delays dividend reinstatement. These options form the basis of our valuation analysis, which will quantify the fair market value under each scenario. My colleague Muskan will now walk you through that analysis.
Thank you, Leah. Before we move into the analysis of our valuation, let's first walk through our WACC calculation. We calculated our weighted average cost of capital using cost of debt and cost of equity. Since the two divisions have different risk profiles, with capital management division having a beta of 1.1 compared to wealth management's 0.9, we calculated different WACCs for the two divisions, as 9.5% for the capital markets division and 8.9% for the wealth management division. The slightly higher WACC for the capital market division reflects its cyclical and volatile nature compared to the predictable and stable stream of revenues for the wealth management division. To calculate the synergy WACC, we combine these two rates based on the size of the division in the new company, NewCo, and added a 2% synergy risk premium to find a synergy WACC of 11.1%. Moving on to the valuation, we used a discounted cash flow approach to value our capital markets division at $798 million. This approach was used to account for the volatile and cyclical nature of the revenues in this enterprise. Revenues were projected using $1 million of fixed base fee and 2% of transaction fees, both adjusted for inflation. Expenses were estimated using 55% of the company's revenue as compensation and benefit, and 40% of the company's overhead costs as this division's overhead costs. Since the company is currently in a promotional deal with their service provider, we maintained the service cost at 2025 levels for the first 3 years and increased them at a 2.5% level thereafter. After reducing income tax, sustaining capex, as well as the 4% change in net working capital, we finally found our adjusted after-tax cash flows. Assuming a 3% growth, we calculated our terminal value, and discounting them back at a 9.5% WACC, we valued this enterprise at $798 million. In contrast, we used a capitalized earning approach to value our wealth management division at $219 million. This was done to account for the more stable and predictable stream of revenue in this division. Since this is stable, we projected our revenues and costs based off of the 2025 level to find an EBITDA of $21 million. However, we noted that one of the fund managers had inappropriately invested $10 million of assets under management in speculative small cap stocks in 2024, leading to a 49% loss compared to an expected 11% return. Thereby, the company is now liable to pay $6 million in settlement loss and forfeit their $0.1 million in management fees. Accounting for tax as well as capex, we found our adjusted after-tax cash flows to be $13 million and our enterprise value to be $219 million. As a reasonability check, we also compared this using our precedent transactions and valued the company using EV over AUM multiple at $257 million. There is an approximate 17% variance in these two valuation methods, but from our research, that is pretty acceptable and expected in the industry. Moving on, since Pinnacle Wealth is a private company with no publicly available financial data, and wealth management companies are usually tend to remain stable regardless of the market conditions, we used an EV over AUM multiple to value this company at $1.5 billion. And lastly, we think that there are some benefits that come from merging these two companies together. And we found that by merging them, one, we'd be able to save 10% of our company's overhead costs, as well as 20% of the company's wealth management division's service costs. Additionally, we noticed that there was a total non-capital tax loss carryforward of $25 million, which would give us an immediate tax shield of $6.8 million. Accounting for the $3 million for early ending of the lease, we valued the synergies at $75.6 million. To determine the fair market value per common share for Crescent Oak shareholders, we added the enterprise values for the past 4 calculations, added redundant assets, including excess cash in Crescent Oak, as well as Pinnacle Wealth, as well as preferred shares in a UK wealth management company, and then finally deducted debt, as well as the lawsuit payments to find an equity value of $2.4 billion. Accounting for 36.5% shares in the new company, NewCo, and discounting them further by 15% to account for the limited control as well as limited ability to direct strategy and capital allocations moving forward, we found the fair market value per share to be $49.6. I'll now pass it on to my colleague, Sabrina.
Yeah, thank you, Ms. Gon. So expanding on our pro forma results, NewCo shares will trade at around $46.4 per share with a total market cap of $2.4 billion. The combined company will have improved liquidity from Pinnacle's $80 million cash reserve and lack of debt, $93.6 billion in AUM, and $76 million in present value synergies from overlapping support functions. However, it's important to note that this merger also shifts control and operating focus as Crescent Oak shareholders become minority holders at 36.5%, representing a substantial dilution of ownership. The merger also introduces integration risks by combining a public capital markets focused firm with a private wealth management firm, and realizing synergies also depends on a $3 million lease termination cost and effective integration of back office operations. Now moving on to the buyout offer, Crescent Oak's senior management team offers totals $45 per share, but when we actually adjust for timing and financing risk, the expected FMV is approximately $35.55 per share. And to determine this, we broke down the cash flows into 4 installments, 15 at closing, 6 months, and $10 per share annually over the next 3 years. We then discounted each cash flow using spot rates of 3.5% and 3.6%, which is consistent with the Government of Canada yield curves as of the valuation date. And this gave us a present value of $42.22 per share. However, since the buyout success does depend on securing financing, we applied a 70% probability of success and a 30% probability of failure, where shareholders would only recover a reduced value of $20 per share. And weighed by these probabilities, we derived an expected value of $35.50 per share. We then calculated the implied share price of Crescent Oak by aggregating the enterprise values of both divisions, so $798 million for capital markets and $219 million for wealth management. We then added redundant assets such as excess cash and preferred shares and subtracted long-term debt, settlement liabilities, and management refund fees, which resulted in an equity value of $727 million, which when divided by 15 million shares outstanding, gave us an implied FMV of $48.50 per share. So while the buyout offer provides near-term liquidity and limits downside risk, the actual share price of $20 significantly undervalues Crescent Oak relative to its intrinsic fair value of $48.50 per share. So essentially, the buyout provides short-term certainty but sacrifices long-term value potential, and from a valuation standpoint, accepting this offer would mean shareholders destroy value. And Here, our qualitative analysis identified 4 key factors to explain the share price discrepancy. The first being market sentiment. Due to the suspension of dividends, investor confidence has weakened as lack of dividends signals financial distress, and short-term market psychology has priced in panic rather than on the company's long-term forecasted recovery. The second being financial leverage risk. Crescent Oak's high debt levels combined with rising interest rates cause investors to apply a higher discount rate due to increased perceived financial and default risk, which depresses the valuation and share price. Another factor is that since Crescent Oak's capital markets division experienced a 95% year-over-year decline in net operating income during the 2025 fiscal year, investors remain skeptical about the division's ability to rebound, pricing in a pessimistic scenario despite management's outlook on a robust recovery. And lastly, the ongoing lawsuit in the wealth management division introduces contingent liability and operational uncertainty, while the related loss in AUM underscores managerial oversight concerns. And together, these issues impact market confidence and contribute to Crescent Oak's reputational risk premium. I'll now pass it on to Leah to talk about the share recapitalization.
Thank you, Sabrina. Now let's look at the recapitalization option and what it means for Crescent Oak. To achieve the industry standard 2-to-1 net debt to equity ratio, Crescent Oak would need to issue approximately 4.9 million new shares at a discounted price of $18 per share. This would raise about $88 million, and the proceeds from this share issuance will be used both to pay down debt and increase equity. As a result, net debt would fall from $294 million to $206 million, and equity would rise from $50 million to just over $103 million. That means the debt to equity ratio improves dramatically from about 20-to-1 to 2-to-1. The pie charts on the left illustrate this shift in capital structure, moving from a highly leveraged position to a much healthier balance sheet post-recapitalization. The bar chart on the right shows the potential impact on dividends payable if Crescent Oak chooses to redeem their $10 million worth of preferred shares from their UK wealth partners. The number of new shares that need to be issued drops slightly to 4.7 million, which lowers the aggregate dividends payable. And more details on dividend reinstatement will be discussed in just a couple of minutes. Okay, now that we've seen how recapitalization improves the capital structure, let's look at its impact on dilution and ownership. This will be based on the case where preferred shares were not redeemed. Issuing these shares would increase total shares outstanding from 15 million to 19.9 million for Crescent Oak, giving new shareholders a 24.6% stake in the company. Post-recapitalization, Crescent Oak would issue enough shares for a 0.754 dilution ratio. The bar chart on the left shows how this affects fair market value per share and shares outstanding. F&B per share declines as the share count rises from 15 to 19.9 million. The pie chart on the right highlights the shift in ownership. New shareholders would hold nearly a quarter of the company. While recapitalization does bring benefits, such as optimal leverage, better credit access, and a more stable equity value, it also introduces some risks. Other than the reduced influence of existing shareholders, dilution also means overall earnings will be spread across a larger pool of owners pro rata, reducing EPS. A large share issuance can also signal financial weakness, which may cause the share price to fall even further. Next, I'll hand it to my colleague Cedric, and we'll look at dividend reinstatement to understand how these changes affect shareholder returns.
Thank you, Leah. First, we projected our unlevered free cash flows for both Crescent Oak's capital markets and wealth management divisions. Afterwards, we subtracted interest expenses and added back dividend income from preferred shareholdings in UK wealth partners, which we also normalized to account for past year's subpar returns. Together, these adjustments represent our firm's cash flows from financing activities. After adjusting for that, it brought us to our cash flows available for distribution. Then, we ascertained that the first year we could reinstate our target dividend, which is $1.89, would be according to the payout ratio, and that's given by Crescent Oak's total dividend expense over its cash flows available for distribution. We decided to forecast this because of Crescent Oak's dividend policy, which ensures that any disbursements first require a payout ratio below 90%, which actually only occurs in 2029. Then, dividends payable were found by multiplying our 19.9 million shares post-recapitalization by the yearly dividend, which is also set to grow by 5% per annum, leaving us with dividends payable of approximately 37.5, then 39.5 million in 2029 and 2030, respectively. Still, we believe this approach is too little too late, representing a reduced present value to shareholders given a lengthy time horizon. And likewise, waiting another 3 years for dividends may actually fail to raise the FMV, given the fact that investor sentiment had already been so amply disparaged by only 1 year of suspended payouts. At the same time, though, the eventual reinstatement of dividends will come with renewed confidence. But we should also consider that a higher payout ratio may actually indicate a poor return on equity, since low retention implies a lack of positive MVB opportunities. And finally, we also ran a discounted dividend model on the proposed dividend schedule, which only represented a $15 per implied share price, which would actually mean a further 25% downside, which is quite substantial. So now, moving on to our valuation comparison, we've compiled point estimates on the top right of the slide, representing Crescent Oak's FMV per share given its two transactional options, as well as recapitalization or maintaining existing operations. And the highest FMV achievable is actually under the pro forma NewCo. The merger offers a $49.6 price, which is closely followed by maintaining existing operations at $48.5, although that comes with a lot more risk. Now, to help elucidate the variance in pricing, we've sensitized the FMVs of our four valuations according to a multi-scenario analysis of discount rates and growth rates. This displays an extended picture, whereby the merger's interval range is more centered on its point estimate as a result of diversification and a more stable entity. That also lowers idiosyncratic risk, whereas the large range for maintaining the status quo is indicative of a more cyclical and small cap company. Meanwhile, share issuance remains relatively risky, with also a lower FMV due to dilution. And the buyout presents certainty, but at the expense of a much lower FMV. This leads to our recommendation for Crescent Oak Special Committee. Pursue a merger with Pinnacle Wealth in order to obtain ownership in a larger, more stable firm, NewCo, which will be diversified in counter-cyclical wealth management operations, raise brand equity and market reach, and provide the largest per-share single gain in FMV of $29.6 or 148%. Now, we'll conclude with a strategic rationale, considering risks and catalysts, which are visualized by the matrix on the bottom right, demonstrating our qualitative factors for our assessment. Crescent Oak's greatest risk for reverse takeover is actually its loss of control. The firm will only hold 36.5% of pro forma shares, losing both voting interests and board appointments. Although, on the flip side, shareholders are really just trading control in a more volatile enterprise for a reduced stake in a more resilient business, a bit like trading a sinking ship for part of a larger, more stable one. Next, NewCo also risks integration failures, since we have $8.1 million in yearly pre-tax synergies that hinge upon successfully combining both firms' IT, culture, operations, and supports. Although, unfortunately, most of our synergies are on their back end, which should be more achievable. The last key risk is reputational contagion from Crescent Oak's pending lawsuit. But the scope of that settlement would actually likely fade against the immense backdrop of a new merger with NewCo, forming NewCo, that is. Now, in terms of catalysts that could accelerate the realization of our appraised $49.6 FMB, first, the merger would form a new titan of the Canadian wealth management industry, with a strong business moat for economies of scale and institutional relations. Additionally, the merger would instantly help stabilize Crescent Oak's financials through safe and recurring fees-based revenues. Lastly, NewCo will also benefit from Pinnacle's carryover tax shield. Although we hope Crescent Oak Special Committee will finally share our recommendation to merge with Pinnacle, de-risking operations, and forming a stable wealth management powerhouse. Thank you so much for everybody for your attention, and now we're open to any questions from the judges during our Q&A period.
Hi, so great presentation. I have a few quick questions. So first, I believe you had a sensitivity output on slide 18. So I'm interested for that sensitivity, what were some of the key variables you considered and what some of your like key takeaways were from like the sensitivity component itself?
Absolutely. I suppose I'll start on our appendix slide 5, so I could take a look at the different sensitivity analyses tables that we performed. So the key two variables that are consistent across most of the business enterprise values were our WACs as well as our growth rates. And we discovered that these were the most important, since the WACC considers both the cost of equity and debt, which is very important for considering our present value for all of our calculations. And as well, the growth rate is something that's quite fickle and it's quite difficult to determine at our present point in time in August 31st, 2025 at the time of the case. So we decided to also sensitize that. Our main discoveries were that the individual business enterprise values had a lot more variance versus combining them together. And again, that's due to a reduction of idiosyncratic risk when we found out that the overall combined merger, which again was for a much larger company, had a lot less of a range. What we did discover, though, is that the individual Crescent Oak shares, if we decide to maintain existing operations, would be a lot more risky. And again, that was visualized by our chart. At the same time, I'll also point to our scenario analysis calculations here. And this is just how we discovered the high and low scenarios, which actually decided the football field range on the slide from before. So that's the overall strategy with it. And again, the key takeaway is that deciding to diversify and merge is a lot more safe with regards to the range of expected value that we can perceive in our shares, whereas maintaining existing operations does risk a lot more, especially given the fact that capital markets are quite fickle as well, which should also be considered qualitatively alongside our existing information. So are there any follow-ups, or hopefully that's decent.
Thank
I
you for
think,
your, oh,
Yeah,
sorry,
sorry,
go
I
ahead.
think the
Go
mute
ahead,
is-
Evelyn.
okay, I was going to say, first of all, thank you very much for that very thorough and well laid out presentation. It sure gives the special committee some really good feedback to allow us to make the decision that is going to be in the best interest of the company and its shareholders. I had one small question as it relates to your calculation of weighted average cost of capital. And I don't know that you had a slide that gave the details, but so I'm just wondering, in your calculation of cost of equity, did you consider any company-specific risk factors in addition to the risk that would be adopted through the use of your beta?
Yeah,
And
great
if
question.
so, if you could just tell us a little bit about what those factors might have been and how they were incorporated.
Absolutely. I guess I'll start with the first factor highlighted over here on the size premium. We decided to incorporate that since, according to the case information, companies from about 300 million to 1 billion, I believe, in market cap have an additional size premium of 4%, which we added on to find our cost of equity that's specific to the firm. Without that, we would simply have considered the market risk premium and beta, which again is a good starting point. However, we wanted to consider the fact that it is a much smaller firm, and we do want investors to kind of like consider that risk when we're finding the present value of our company. Otherwise, we're not correctly accounting for the fact that it's, again, a small cap firm that does pose a lot more default risk or delinquency risk that we have to consider, although hopefully it won't be a problem in this case. Furthermore, I'd also like to just highlight the fact that we did also consider a sort of blended WACC for the synergies, and that considers a lot more sort of company-specific information as well. Since we added on a synergy risk premium, which my colleague Muskan briefly mentioned in her slide there, and that the key purpose of that is the synergies are not guaranteed, again, because of that integration risk. So we also wanted to add on additional 2% there, which is within the typical range of 1 to 3% according to rules of thumb for this sort of situation, just to make sure that our synergy WACC correctly considers that risk as well.
Just that last answer there, portion, you were referring to a rule of thumb of 1 to 3% for synergy risk premium. Just curious where that came from. Do you have a source for that?
I think it was from an old CBV Institute study. I know we looked at a few of them in our case. For example, for the 2016, I believe, minority discount case that we referenced to find our minority discount value. And I could get back to you with the specific paper, but unfortunately, my memory's failed me today. But typically, the range was between 1 to 3%. And also, we just thought that was more appropriate since it ends up being higher than both of the individual divisional WACCs, which would be a lot more appropriate than suggesting that synergies could potentially be less risky than the individual company.
That's great. Thank you.
No worries.
Yeah, I would reiterate what the other judges have said so far. I think that was great. You guys really covered all the points really well. I was very impressed. A couple of small questions. I noticed for the wealth management division, you guys did do the secondary approach of comparing to the transaction multiples. And there was a comment saying that you noted that your capitalized cash flow result was lower than what would have been implied by the market approach, and that this would be expected or consistent with your expectations. And I was just wondering if you could elaborate a bit on that, or like why is that consistent with your expectations?
Absolutely. Cedric, could we move back to the wealth management slide, please? Thank you. Amazing. Thank you so much. So when we were accounting using the capitalized earning approach, we were also taking into consideration normalization adjustments because we did see loss in asset management because of the mismanagement of the assets last year. And we found that the enterprise value using this approach would be $220 million. But when we used the reasonability check or the precedent transaction analysis, we looked at a lot of companies. However, we decided to exclude two, which were one of them that happened in 2017, and one of which was more of an asset management software instead of an asset management service firm. So we took the average. However, saying that being said, that is not an accurate, or that doesn't mean that is exactly the EV over AUM multiple that will give us the correct value. And the variance that we see is 17%. So 220 versus 257, we see an approximate $37 million value. And from our research, we found that usually it's reasonable to have a 15 to 25% difference in the enterprise value when you're using two or more methods to value a company. So looking at the revenues from past year and looking at the enterprise value of 220 million, it made sense that it's okay if it's a little bit less than enterprise value because those are very generic numbers and do not give us more details about what exactly went in those transactions.
Okay, thank you for that answer. And then just another question. I noticed that you used the risk-free rate to discount the payments for option 2, the buyout. Can you just provide some context as to why you use the risk-free rate?
Yeah, I think I can elaborate on that. So we did originally consider whether or not to use the WACC, but after kind of doing some like reasonability checks and thinking it through, since WACC reflects kind of ongoing business risks of operating assets, and here the buyout deals with fixed contractual payments, we kind of thought using the risk-free rate would be more appropriate as our discount rate, just because the government kind of spot rates would, yeah, again, essentially be more appropriate and based on the structure of the payment.
Awesome. Yeah, great. It's a great answer. Thank you.
All right. Sounds like that's all for questions from the judges.
Actually, Kevin, I do have one more.
Okay, go for it.
Time. Just curious
Yep.
about group dynamics. How did you guys decide how to allocate work across the team?
Yeah, that's a great question as well. I love hearing a bit about the collaborative process because it's very important both for our case and actually working as a CBV. So I'd say that the main distribution can be best kind of visualized here by our executive summary. So we decided to kind of divide in two key sections. The first one was according to the buyout offer and the sort of enterprise value calculations for the merger, as well as the first kind of two options, transactional options that is sort of for the either buyout or the, again, reverse takeover. And then the second section was for share recapitalization as well as the dividend forecast. So we thought this kind of made a lot of sense since those sections were quite interrelated. And then we kind of separated ourselves into two cross-functional teams of two people. And effectively, that made it a lot easier to get the work done on time, and also to work with each other and make sure that we were constantly verifying that our information was correct and everything looked kind of spotless. So myself and Leah worked on the section 3 here on the agenda, and section 2 was the sort of main strategy for Muskan and Sabrina. And together, I think we did a pretty good job that we're happy with. Discovering all the different sections and sort of putting it all together in a comprehensive analysis. And then for our overall conclusion, we all came together to work on that, deciding based on our own interpretations of the different qualitative factors, as well as the comparison of our relative FMVs. Also, working on the same Excel made it a lot easier since we could kind of always monitor what was going on and how the numbers were looking.
Thanks for that. As a follow-up question, was there a fifth person, AI? Did you incorporate AI at all in putting this presentation together?
Not too much. I suppose the only case I could think of would be for checking numbers. For example, if we decided to run in like one of our calculations for FMV just to make sure we didn't make any careless mistakes, it could sometimes be useful as an additional reasonability check. Although I don't think we had any major help from that because I suppose they used to call me in my high school Cedric GPT, so I think I can do most of the thinking in this case. I think I like to suppose. So yeah.
Great, thank you.
No worries.
Any follow-ups from the judges, or are we good to send you off to your breakout room?
I'm all good, I think.
Yeah, I'm good. Thank you very much.
Okay. Excellent job, Team One. Way to start off strong. You folks can leave the meeting now. And for the judges, we'll move you to a breakout room. And for everyone watching online, we will be back at, I believe, 11:30.
Sounds good. Thank you so much, everybody,
you
for
so
your
much.
time. And
Thank
you.
you, everyone.
happy
Enjoy the
Thursday.
rest of your day.
Good morning, everyone. How are you doing?
Good morning.
Good
Good.
Morning. Doing good. How are you?
Very excited for the final presentation.
Excellent. That's good to hear. That's good to hear. I know you guys were hard at work overnight updating your presentation, and the judges are eager to watch. So I'm just going to make sure that we have everyone here before we get started. Okay, we have 1, 2, 3, 4 presenters, and all of our judges are here, so that's good. Okay, so with that, Team 5, I'm going to hand it off to you. It's 11:29 right now, so well, we'll start at 11:30. We'll give you till 12 o'clock. 20-minute presentation, 10-minute Q&A. One of your members of your team can share your slide whenever you're ready and begin.
All right, I'll quickly share my slide.
Best of luck.
Just to confirm, can you guys see your slide?
I can see your slides.
All right, thank you so much.
All right, so thank you all for joining us today. My name is Danielle, and I'm an associate here at Valuations LLP. We'll be walking you through our proposed solutions to the challenges that Crescent Oak is currently facing. So just an overview of our agenda today. We're going to start by talking about the business overview, moving on to the executive summary. After that, we'll have the WACC and capitalization rate explained, Crescent Oak's valuation. Then we'll be talking about all 3 options, which would be merger with Pinnacle Wealth, management buyout, share recapitalization, and then we'll finish off with our conclusion. So to start us off with our business overview, Crescent Oak Partners Incorporation is an investment bank operating through 2 main divisions. So we have the capital markets and then we have the wealth management. The capital markets division focuses on guiding private companies through the IPO process, while the wealth management division provides stable, fee-based revenue through managing the company's assets. Recently, Crescent Oak has faced significant financial challenges due to rising interest rates, inflation, supply chain disruptions, and a slowdown in the Canadian economy. These factors have caused a steep decline in IPO activity, reducing capital markets revenue and putting a strain on the company's earnings. Rising interest costs on the company's floating rate debt have further strained cash flow, ultimately forcing Crescent Oak to suspend its FY 2025 dividend. After announcing this to the public, Crescent Oak share price fell roughly 60% from $55.02 to $20 and has remained near this level since. In response to this, the board established a special committee to review options aimed at restoring investor confidence and reinstating dividends. The committee is currently evaluating 2 main options, the first one being merging with Pinnacle Wealth Management, a privately owned firm with $80 billion in assets under management. This could create synergies and immediately improve liquidity. The second option would be accepting a management-led buyout offer to take the company private for deferred cash consideration. Alternatively, the company is also considering an equity recapitalization, raising additional equity capital to pay down debt and improve the company's overall financial position. Ultimately, Crescent Oak's goal is to determine which path will best restore shareholder value and position the company for long-term stability and growth. Moving on to our executive summary, Crescent Oak evaluated 3 strategic alternatives to restore shareholder value and long-term financial stability. So the merger with Pinnacle Wealth, a management buyout, and an equity recapitalization. While the merger does not produce the highest fair market value per share, valued at $43.34 versus the $45.91 for the management buyout, and a $46.69 for the recapitalization, it delivers the most strategically sound and sustainable outcome. The merger fundamentally transforms Crescent Oak's business model by shifting 85% of revenues toward recurring wealth management fees, reducing dependence on volatile capital markets income. It introduces $120 million in tax after synergies, a $6.8 million tax shield benefit, and a balanced 2 times leverage structure. This enables earlier dividend reinstatement and stronger long-term free cash flow growth. Although Crescent Oak shareholders would hold a 36.5% minority interest in the combined entity, the partnership provides exposure to Pinnacle Wealth's $80 billion AUM platform, enhancing scale, diversification, and market positioning. The management buyout and recapitalization each deliver higher immediate valuations but carry higher execution and financing risk. This limited scale benefits and continued exposure to earnings cyclicality. Overall, the merger with Pinnacle Wealth offers the most durable value creation, balancing near-term stability with long-term growth potential. It strengthens Crescent Oak's earnings foundation, reduces risks, and positions the company as one of Canada's leading independent wealth management firms. I'd now like to hand it over to David.
Thank you, Danielle. So my name is David. I'm an associate here, and I'll briefly touch upon the financial forecast as it builds the basis for both my standalone valuations. As you can see on this slide, the capital markets revenue grows from 95 million to 278 million by fiscal year 2030. This is supported by the rise in IPO activity and stable market share, with EBITDA margins expanding from 25% all the way to 30%, 32%, and free cash flow increasing from 24 million to 52 million. Wealth management AUM rises from 13.6 billion to 15.9 billion, driving revenue growth from 156 million to 177 million, while EBITDA margins widen from 11.4% to 14.2%, and free cash flow grows from 12 million to 17 million through scale efficiencies. So we decided to use the base case when showing financial forecasts. A base case is important because it represents the most realistic or expected scenario. It acts as the middle point to compare other outcomes to, and it's like the best or worst case. When showing EBITDA margins percentage, EBIT margin percentage, revenue growth percentage, the base case helps with providing a clear benchmark to show what assumptions you're using as supporting valuation or business making decisions. Now, let's touch on the consolidated outlook of the company. Overall revenue grows from 38% from 330 to 455 million, while EBIT nearly doubles from 58 million to 109 million by fiscal year 2030. However, approximately 60% of earnings remain tied to the capital market cycle, underlying the strategic importance of option one, the merger with Pinnacle Wealth, which would shift the combined entity's revenue mix towards 85% wealth management, providing greater stability, recurring income, and long-term value creation. I'll now dive into the Crescent Oaks WACC and capitalizations rate. As you can see from the slides, we have listed our key assumptions. When estimating the WACC, we decided to use the CAPM to estimate this cost of equity. The CAPM is the most reliable model based on the information provided. We also decided to add a size premium of 4% to account for the company's size. We estimated a 5-year forecast period to match this. We decided to use a 20-year T-bill yielding 4% as a proxy for the risk-free rate. The betas for both divisions differ. The capital markets division was 1.1, having a higher beta than the wealth management of 0.9. The corporate tax rate also was 27%, which is consistent with the Canadian tax law. An important thing to note is that Crescent Oak has a 350 million in a term loan that is set to expire fiscal year 2031. The term sheet states that the rate is determined by 7% SOFR plus spread. This represents a large liquidity event that Crescent Oak will eventually need, either the revolver, the financing to make a full payment. Here, we decided to add a sensitivity analysis on the WACC and capitalization earnings, as you can see on the slide. Beta has a high impact shift in WACC by 4 basis points. The WACC is less sensitivity to the shifts within the risk-free rate as the capital structure favors debt, ultimately softening the impact of higher rates on risk-free assets, example, the T-bill. Capital markets then impacted by higher beta to reflect the risk profile. Let's dive into what we've all been waiting for now, the valuations for both capital markets and wealth management division, and I'll analyze the share and approach for both and why. So as for the DCF model, as you can see, the capital markets division revenue is dependent on IPO activity with expected base fees of 1 million per IPO and performance fees of 2%. The average transaction is 192 million in fiscal year 2025, projected to grow at 4% annually. A DCF allows precise modeling of these variable cash flows from 2026 to 2030 before applying a long-term growth rate of 3%. Deal stats project IPO transactions to increase from 350 to 480 million by 2026 to 2030. This is a clear year-by-year projection supporting a DCF approach rather than a single multiple, as it captures the fluctuations and division estimates, 10% of the market share in Canada. The capital markets enterprise value was 810.4 million. Now I'll touch on the capitalization earnings model. A capitalization's earning model is a business valuation method that estimates a company's value by dividing its expected earnings by the capitalization rate. It's most useful for stable businesses with predictable earnings. The wealth management division generates recurring assets under management fees of 1.1%, which has grown steadily. This consistent revenue stream supports the methodology because it focuses on normalized earnings rather than projecting volatile cash flows. The recent 10 million loss from a speculative investment and associated lawsuit can be treated as a one-time non-recurring event, along with the capitalized earnings model to focus on sustainable recurring earnings of the wealth management division. Other adjustments, such as the compensation distribution policies, can also be incorporated. The wealth management division has minimal incremental capital expenditure and stable overhead costs, meaning its normalized earnings closely reflect cash generations. With AUM primarily focused in large cap Canadian companies and a long-term capital preservation objective, the capitalization earning model captures the ongoing value of mature, low-risk business. And some adjustments, as you can see here, are the 10 million that was inappropriately invested and the management fee rate. And also we made assumptions which were consistent with professional compensations. And we also factored in 110,000 in termination fees. Wealth management enterprise value was then calculated as 516.2 million. Now I'd like to pass it over to Nathan. Thank you, guys.
Thank you again to my fellow colleague for walking us through the valuations of both the wealth management division as well as capital markets. Now, evaluating option one, which is the Pinnacle Wealth merger. Essentially, Pinnacle Wealth has essentially offered us to merge and create a new entity called NewCo. Now, when we were evaluating this potential merger acquisition, we had to make sure to essentially use a valuation metric that was consistent with the industry. From here, we used EV to AUM. Essentially, when creating the precedent transactions, we realized that there was a few transactions that didn't necessarily fit the geography or the investment thesis that Crescent Oak or Pinnacle Wealth had. So we decided to filter those transactions out. Now, drawing your attention to the precedent transactions, we had a median AUM of roughly 46 billion and an enterprise value of 585 million. This ultimately represented an EV to AUM of 1.6% that we will be applying to the merger acquisition. Moving into essentially the synergistic value and tax and integration benefits, we started by looking at the cost synergies. Because cost synergies are more likely to actually be realized, we decided to spend majority of our time here. We started with corporate overhead, which we seen reduced by 10%, netting us a 2.7 million annual saving after tax, as well as a wealth management cost of service reduction of 20%. This resulted in a $5.4 million in annual savings, ultimately bringing us to a $5.9 million after tax in total annual savings. From then, we realized that Pinnacle Wealth essentially closed down their investment banking division. And from closing down the division, they were able to carry forward some of their net operating losses. So through the merger, they will be able to apply this as NewCo against some of their losses. So as a result, we decided to factor in the 6.8 million after-tax value of those net operating losses. Lastly, the last item we had to consider was the lease termination cost. So we would have to pay a fee to essentially consolidate all of the offices so that we recognize some of the efficiencies listed above. Now, in terms of the net synergistic value that we calculated, we decided to use an average WACC between both the capital market division as well as the wealth management division to arrive at a net synergistic value of 120 million. Following into just some of the flows of the merger transaction and how we got to the total value of NewCo, we started by essentially combining and using the 1.6% in EV to AUM multiple that we calculated earlier, And we applied that to the current assets under management that Pinnacle Wealth has to arrive at the equity value of Pinnacle Wealth. And as my fellow colleague touched on earlier, we then used the Crescent Oak capital market and some of its parts, so the capital markets and the wealth management divisions, to arrive at the total equity value of roughly $1 billion. From there, we then added in the synergistic values and arrived at a total and equity value for NewCo of roughly 2.5 billion. Lastly, just to conclude, looking at the post-merger transaction, we were then able to calculate Crescent Oak's new ownership stake, which was roughly 36.5%. From there, we leveraged a minority discount rate of 30%, which is consistent with what we see in the market today. So then we arrived at an equity stake after considering the minority discount of 650 million. From there, we took the total shares outstanding to arrive at a per share price of $43.34. Essentially, we didn't factor in any of the revenue synergies that we may have seen. So the upside is essentially uncapped and could be a lot higher than what we calculated here. As a result, we also did a sensitivity analysis to see how sensitive essentially the share price was to the minority discount, as well as the minority stake that we have in NewCo. Now, I would like to invite my fellow colleague to talk about the other options.
Thank you, Nathan. Now turning to option 2, the management buyout proposal. The management group is offering $45 per share, but there is a catch. It's not all upfront. You would get $15 per share when the deal closes, and then 3 payments of $10 each year after that. $45 sounds great on paper, but which is like 125% more than what the stock is trading at right now. But when you actually look at what those future payments are worth today, it's a different story. We used a 14% discount rate, which matches the Crescent Oak's cost of equity to account the time value of money and the risk involved waiting for those payments. When you do the math, the offer is really worth about $35.79 per share in today's dollars. But here's another issue. The management group doesn't have the financing yet. They need to raise about $675 additional million, which isn't easy in today's credit market. Looking at the current market conditions and the company's debt situation, we think there is roughly a 30% chance that this deal doesn't go through because of the money. When we factor in that risk, the expected value comes out to be $45.91 per share. That's basically a 70% chance that the deal happens and you get that $35.79 present value versus a 30% chance that it falls apart and the stock goes back to what we think it's worth on its own, which is $69.51 per share, as for our DCF and capitalization analysis. Now going to the equity recapitalization and share issuance analysis. To get Crescent Oak's net debt to equity ratio down to 2:1, which is pretty standard for the industry, the company need to raise additional $132 million through a new stock offering. If they price the shares at $18 each, which is a 10% discount from where the stock trades now, they would have to issue an additional $7.3 million shares. Now here's the trade-off. The company is currently trading at $15 million per the company currently has $15 million shares outstanding, and this would bump up to 22.3 million, which means the existing shareholders would see their ownership diluted by about 33%. But on the flip side, this recap would bring net debt down to 294 million and push back the book equity to up to 147 million, which hits the 2:1 leverage target. Once you account for the dilution, our analysis shows that the stock would be worth $46.69 per share, which is a 133 increase from today's market price. Now to the dividend reinstatement and feasibility analysis. The special committee asked us to look at whether Crescent Oak could start paying dividends again if they go with the recap plan. We ran the numbers on cash flow available for distribution from 2026 through 2030. We also stuck to the company's dividend policy, which says that they need to maintain a 90% payout ratio, and once they reinstate dividends, they will grow at 5% each year. Here's what we found. In 2026, Crescent Oaks will approximately generate 35.5 million in CFAFD, which works out to be $1.59 per share. But bringing the dividend back at the target level of $1.89 per share, they would need to pay out 119% of their available cash, which is way above the 90% limit. So we can't restart the dividend in 2026. Same with 2027. CFAFD improves to 42.5 million, but reinstating the dividend at $1.89 per share would still require a 99.3% payout ratio, which is still outside the company's 90% policy threshold. So dividend reinstatement isn't feasible in 2027 either. By 2028, things finally work. The company can reinstate dividends at $1.89 per share with an 87.1% payout ratio, which falls within the policy limits. So 2028 is the final year it actually makes sense to bring the dividends back. From 2028 on, the dividend would grow by 5% each year, like the policy says. That means it would go to $1.98 in 2029 and $2.08 in 2030. And here's the good news. The payout ratio would actually drop to 74.4% and 67.8% over those years, which means that the company is generating more and more cash cushion and dividends are becoming increasingly sustainable. Thank you. Now I would like to pass over to Daniel for the final conclusion.
All right, so for our final recommendation in evaluating Crescent Oak strategic alternatives, option 1, the merger with Pinnacle Wealth, remains the most compelling path forward. Although its adjusted fair market value per share is $43.87, it's below the standalone option. It offers long-term value creation and strategic transformation. The merger unlocks approximately $120 million in after-tax synergies, a $25 million tax shield, and establishes one of Canada's top 5 independent wealth management platforms. The combined entity's 2x leverage supports an efficient, balanced capital structure while generating stable recurring earnings. While Crescent Oak shareholders' ownership would decrease to 36.5%, resulting in partial control dilution, that diversification and scale benefits significantly outweigh this limitation. Integration complexity and private valuation uncertainty are manageable given the strong operational overlap between both of the firms. In comparison, the management buyout at $45.91 per share preserves independence but introduces financing, liquidity, and deferred payment risks, while the recapitalization at $46.69 per share achieves balance sheet repair at the cost of a 33% dilution and limited growth acceleration. Overall, the merger with Pinnacle Wealth offers the most strategically balanced outcome, enhancing earnings stability, enabling dividend reinstatement by FY 2028, and reducing exposure to capital markets volatility by shifting 85% of revenue to wealth management. This position Crescent Oak for sustainable long-term growth and shareholder value creation. Thank you for joining us again. We'd now like to open the floor to any questions you may have.
Yeah, again, great presentation. So I noticed you had included some high-low analysis, which I don't think was in the core slides. It's in your appendix. So I'm interested, was there any components from that analysis that you thought was particularly relevant or you considered in your final conclusion?
Yeah, I'll take this question. Zay, can you please pull up the PowerPoint?
Sure.
Just give me 1 second. But we ran 3 scenarios, 1 being the base case, 2 being the best case and worst case. And essentially in the base case, we estimated a lot of variables, 1 mainly being for the wealth management division, the returns that they would generate. So for this situation, we estimated they return just as much as the market would return. So that would roughly be 8%. And that was one of the factors that we had to consider going forward. So then there's other assumptions, but as my colleague Z pulls up the PowerPoint, I will get more into grids. But as of right now, the returns was one of the key determinants in our model.
Okay.
Yeah.
One question. Is the PowerPoint visible?
You can't see it now, but that's helpful. The answer was sufficient. So for next, so you touched a bit on the plummeting share price. So now we're at the $20 share price, substantially lower than the fair market value. So I'm interested to get some more of your thoughts around why the market might be underpricing it right now.
So I'll take that question. So what I believe is that like after the dividend was like suspended in the fiscal year 2025, I feel like it was an over reaction with the recent news that the company did with regards to the CM division and the suspend of dividend. So what I feel like it was an overreaction from the shareholders. And when we look at those numbers with the wealth management division, our DCF estimates a fair value of $69 on a standard like status quo basis. And majorly, we feel that with the merger, it has the potential to grow up, uh, as well as regards to like share issuance and like dividend reinstatement, which just basically solves the current issue of raising debt to like raise book equity value and reach the net debt to equity ratio. It only solved the short term problem. But when we look at the future alternatives, it seems like the merger seems a good value for us.
Yeah, thanks.
Is it possible to pull up your PowerPoint again? I just had a couple questions still dealing with the recapitalization and the dividend reinstatement. I just thought it would be easier if the slides were in front of us to answer
Sure.
those questions.
Is it available? Like, can you
For sure. I'll start working on it now. I'll pull it up in just a minute.
Okay, so I think my first question relates to slide 15. And I'm just curious if you could tell me, issuing these new shares will result in a cash inflow to the company for the proceeds. And it appears on slide 15 that you haven't assumed any pay down of the debt with those proceeds when you're arriving at your new debt equity ratio. And I'm just curious what you assumed the company would do with those proceeds. I see your target capital structure is still showing the net debt of 294 with the revised book equity of 147. So with the proceeds, I'm just curious that you haven't paid down the debt, what you assumed the company would do with those proceeds instead.
I'll take this question. So instead of paying down the debt, we assume that the company would essentially use it to, again, further their operations. That is, maybe invest in some client acquisition costs to acquire more high-end clients to continue building that wealth management division, as well as maybe even use some of that cash to acquire other companies to continue rolling up the wealth management platforms within Canada. But as of right now, we assume that cash would be on hand and they would use it for other strategic analysis.
I guess a concern from the strategic committee would be, to the extent we can minimize the number of shares that we would issue, it'll reduce the dilution of our current shareholders. And we do have, I think, 56 million of excess cash already on the balance sheet. So I just wasn't sure if that was the best approach to take, but I appreciate your feedback. If we could move to the next slide, it kind of continues my question. And that is when you're looking at the dividend reinstatement, I noticed that the cash flow available that you're determining in that top right-hand corner appears to start with EBIT and then taxes, depreciation, CapEx, and working capital. But I'm just wondering where the debt servicing costs are included in there, because I think the formula requires debt, principal and interest repayments to be reduced as well in determining available cash flow. And if it was omitted, maybe what impact you think that would have on your conclusions?
I'll take that question since I made that. So honestly, when I was going through the formulation, I think it's like unfortunate that we missed the debt interest expense on that. And that was actually like if we add that into consideration, that would lead to negative 5 million from each year's fiscal years, and it would actually make the dividend reinstatement even more harder for the like future payments. So since the debt like CFAFD will be less than $5 million of which is like the total interest expense from each year. So yeah.
So it would delay the dividend reinstatement
Yeah,
for.
even.
Okay, super. Thank you for
So
your help.
yeah, so after that I feel like that in 2028 it won't be possible to reinstate dividends since the payout ratio is very close to 90%. So we will have to probably start dividends from 2029. And that could even add more stress to the shareholders because when we recently like suspended interest payments in 2025, the share market price dropped to 60%. And when we don't continue to pay them for like 3 more years, it could go even down lower.
So I guess in the end, that capital reinstatement isn't, or the recapitalization really isn't a great alternative for the
Yeah.
company to look at. Okay,
Definitely.
great. Thank you.
Yeah, and just a quick one from me. Also on the recapitalization, I noticed that in your calculation of the fair market value per share under this scenario, it appears that you're using the intrinsic value as opposed to doing it based on the actual trading price of the shares. So I guess just in that, you're assuming that post raising this additional equity, that the share price would recover to be closer to intrinsic value. And I'm wondering if that was your thought process, why you think that would be the case, especially just given that the dividend reinstatement wouldn't happen till, I mean, even let's say the earliest 2028.
Would someone from Team 5 like to answer the question?
I'll take this question. Sorry, may you please repeat your question?
Yeah. So on the recapitalization option, I believe the value that per share you guys came to contemplates I think the sum of your, like the intrinsic value. So the value you calculated using your DCF for your capital markets and the capitalized earnings for the wealth management, as opposed to the like share price, like the outstanding, like the trading price, which was $20 plus the issued shares at $18. And so I guess I was just wondering, like, given that analysis, I guess you're assuming that their price would recover to that intrinsic value. And I was just wondering if that was your thought process, why you think that would be the case.
Well, we when we did this analysis, initially we thought about the fact that the share price is a lot lower than it could have been because of the dividend being cut and slashed. So as a result, we thought from different angles, and we came up to the conclusion that we actively have a share recovery plan that we're looking to implement and get the share price to where it was previously. So we, in our analysis, we decided to use that. But again, that the plan itself would take some time. So that's why we used the forward or the essentially the intrinsic value here instead of the current market price.
Okay. Thank you. That's it from me.
Thanks for the presentation today. That's great. I was just curious. I have two reports in front of my desk, one from 2 days ago, one from yesterday, and sort of just curious. I didn't have time to look at them both. Can you tell me if you've changed anything from the two reports at all and why?
Yeah, so I'll touch on this one. So from our first report, we didn't include minority interest. And after, careful consideration, we realized that that needed to be factored in. So that's what we added into our analysis. Could we go to the slide with the minority interest? So yeah, as you can see here, we added in a minority interest discount as we realized that for the merger model, we did not have this analysis in it, and that's what kind of changed our value per share. Because our value per share, as we said, was on the high end for the merger, but after we initiated the minority discount, we realized that it wasn't. But then we also figured out other factors to why we did select the merger over the other higher share value per share prices. So that's one thing that we kept out the valuations, but we included in afterwards and were able to conclude.
Thanks for that. I have one more question. Obviously at our firm, there's a lot of fee pressure with clients, and I'm just wondering, is there anywhere you can incorporate AI into the analysis so that we can get more efficient and against other firms?
Yeah, I think that are you speaking, can you clarify, are you speaking for our analysis or your
Our work, how we can reduce the number of hours, make it more efficient, make it more
Yeah, definitely. I think AI,
correct.
oh sorry. I think yeah, AI is a growing, market, a growing trend. So I think we always have to implement it. I think instead of relying on it, we use it as an ally, and we use it to double check or double cross the work, but don't depend on it. I think that having diverse mindset, group of people, is sufficient, but having to cross check it through a platform that has also some thoughts of that were implemented by other people is still a good proxy to use towards coming to conclusions.
Okay, thank you.
Great. I believe that's all the questions the judges have and all the time we have. So with that, I'll thank you, Team 5, for your time. Great work today. And you folks can leave the room. Judges, you'll be moved into a breakout room for your deliberations momentarily. Thank you.
Thank you.
Thank you so much. Have a good day.
Good afternoon and morning, Team 8, wherever you might be located. Thanks for joining us today. We're a little bit early, but I think a member of your team can go ahead and share their slide just so we're ready to start at 1 o'clock. Good afternoon or morning, Team 8, and welcome. I think there was a little bit of mix up there. You guys were brought in and I think kicked back out, but one of you can go ahead and share your slide, and you're good to start at 1 o'clock on the dot, okay?
Perfect. Thank you.
Late night for you guys?
Not too bad,
Okay.
but yes.
You know what? Why don't you can start whenever you're ready. We're pretty much at 1 o'clock, and I'll hand it off to you guys. Best of luck.
Thank you. Hi, everyone. Thank you so much for joining us today. We're so excited to present to you our Crescent Oak valuation report. My name is Maya, and I am joined by my colleagues, Kaywin and Alan, and we're so excited to present to you this internal memo. The valuation date is as at August 31st, 2025. Now, taking a look at our agenda for the day, we will go through our executive summary, followed by the divisional analysis of Crescent Oak's Capital Market Division, as well as the Wealth Management Division. Then we will go through the option 1, potential to merge with Pinnacle Wealth, followed by option 2, the buyout from management, and then the share recapitalization, including the issuance of the new common shares, as well as the dividend reinstatement, followed by our strategic comparison and recommendations, then our implementation and next steps. Moving into our executive summary, the key objective of this presentation today is to answer the key question of which strategic direction Crescent Oak should pursue to maximize the fair market value per share for their existing shareholders. Now, keeping this priority in mind, we went through an analysis of both divisions, the Pinnacle Wealth merger, the management buyout offer, and the share recapitalization. Our findings here can be found on this football graph, but our ultimate recommendation is to go forward with the Pinnacle Wealth merger and create NewCo. Now, this is based on the highest upside for the current shareholders, as well as quantitative and qualitative benefits. Now I'll pass it over to Alan to go through our valuation approaches.
Thank you, Maya. So as a quick review, we understand there are 3 main types of valuation, being the asset-based, income-based, and market-based approaches. For our analysis today, we primarily relied on the income-based approach method, while also using the market-based approach for the Pinnacle Wealth valuation. Within the income-based approach, we've assigned the Wealth Management Division to the CCF valuation because of its stable, consistent, and predictable earnings. On the other hand, for the Capital Markets Division, we've used a discounted cash flow methodology because of its volatility and unpredictability.
Now, taking a look at our different WACC calculations for both the capital markets and wealth management divisions. So starting with the capital markets, we got to a cost of debt of 5.11% using the SOFR plus 1 rate that was given within the case, as well as our tax rate of 27%. For a cost of equity, we utilized the assumptions given in the case, including the risk-free rate, beta, and market risk premium, as well as the size premium. However, we also added a specific risk premium for Crescent Oak's Capital Markets Division of 5% because of the risks outlined on the left-hand side of the screen. So this includes cyclicality and volatility of this market, the revenue concentration within the IPO division, as well as the susceptibility to market dynamics, as this is very much tied to how the IPO market is performing. This got us to a cost of equity of 19.6%, and when we weighted the two against each other using the 2-to-1 ratio that's optimized for Crescent Oak, we got to a cost of capital of 9.94%. Now, for the Wealth Management Division, we got to the exact same cost of debt, but for the cost of equity, we only used a 1.5% specific risk premium. This is due to the stable and predictive revenue that comes with the market, as well as the capital light model and shareholder liquidity. Again, when we weighted these two against each other, we got to a cost of capital of 8.37%. Now, taking a look at our capital markets discounted cash flow, we projected out cash for the next 5 years using the number of IPOs and the fees that were recommended within the case. We then brought this down to our NOPAT by reducing tax, and then we added back depreciation and amortization, less changes in working capital and sustaining capital expenditures to get to a free cash flow for the forecasted 5 years. We then discounted using the WACC presented on the previous slide to get to the present value of those cash flows. And then for our terminal value, we used a 3% growth rate to get to a terminal value in 2030 of $926.2 million. And then when we discounted that back, we got to a present value of 576.7 with a total business enterprise value of $744.7 million. Now, going into our wealth management capitalized earnings, we took a different approach based on the stable revenue that comes with this division. So we took our EBIT for the 2 years that were forecasted within the case. We deducted income from preferred shares to get to an adjusted EBIT, and then we averaged the 2 years to get a more realistic number for what our EBIT would look like moving forward. For then our earnings multiple, we took our discount rate and our growth rate to back into a capitalization rate, and then multiplied that up to get an earnings multiple of 18.61 times. When applying this earnings multiple to our AUM, we got a wealth management operations enterprise value of $195.4 million. We did gut check this valuation using the precedent transactions from the Pinnacle Wealth merger, and we found a spread of 5.7%, validating our capitalized earnings approach. We also do want to highlight one key assumption that was made, which is the divisional growth rate outlined by management. We believe that this 4% rate, though, is quite accurate for how this division will grow in the future.
So now to get into the combination of the two. So we've taken both the enterprise values for the CM and the WM divisions to get a total enterprise value of roughly $940 million, then added back redundant assets, which is the fair value of the investment in preferred shares. We've subtracted the lawsuit liability present value and the net debt of the company to get a total equity value of $648.97 million, which leads us to a fair market value per share of $43.26 in our base case. At the very bottom, you can see sensitivity table where we've sensitized both the CM and the WM risk premiums in WACC. As we understand, these are the most subjective parts of the valuation determination. Now, on the right hand of the screen, we wanted to investigate why the share price of $20 on public markets differs from our fair market value per share of $43.26. So what we know about public markets is that they're generally short-sighted. They're just a price set by supply and demand and not through intrinsic value. And they're usually emotionally driven with psychological and emotional factors at play. On the other hand, intrinsic valuation is fundamental, logical, and determines long-term cash generation and does not reflect emotional or psychological reactions, but may consider the associated risks. And so therefore, we believe that the $20 public market share price differs from our FMV at the valuation date because it's an emotional and short-sighted public response to the company's missed dividend. And this is further validated by the fact that the earnings report for the company would not have released by the valuation date. And so therefore, we can assume that it's all because of the dividend missed payment. And a great study of this is General Electric from 2017 to 2018. They also had divisions, and one of them being power, which was highly cyclical and debt-ridden. Between November 2017 and October 2018, they essentially had their dividend cut all the way to just 1 cent per share. And this led to a stock price that the value of the stock price fell 74% in the same time.
Perfect. So now we'll take a look at the Pinnacle Wealth precedent transactions. These 6 different precedent transactions that were outlined by Crescent Oak. We would like to point out that the one on the far right side, Good Planet Investment, was deemed to be an outlier because the transaction date is over 9 years old. So with the 5 that we did consider, we took the transaction value and divided that by the assets under management to derive the EV over AUM multiple as a percentage. Then we took the median and the average of these multiples and we decided to go with the median because it best represented all of these multiples, and it was further validated by external comparables from Capital IQ. In any of the acquisitions that were less than 100% acquired, the AUM was grossed down proportionally. With that, to derive Pinnacle Wealth's enterprise value estimate, we took their $80 billion AUM forecast, multiplied that by the median multiple to derive the enterprise value estimate of $1 billion. We decided that with a lack of information on Pinnacle Wealth, unintrinsic valuation methods were unavailable, so precedent transaction valuation method was the most appropriate. Now moving into the synergies for Pinnacle Wealth, we took a sum of the synergies, Synergy A, which is a tax loss carry forward, Synergy B, the corporate overhead costs, and C, the wealth management division cost of services savings. First, breaking down Synergy A, we took the tax loss carry forward balance at acquisition from Pinnacle Wealth of $25 million and brought that down to the present value of tax savings to derive a $6.2 million present value. Next, for Synergy B, the corporate overhead cost synergy, with the corporate overhead costs of $27.2 million. We then took the blended WACC approach. This new WACC was adjusted for the decrease in the size premium of creating NewCo, then further deducted the one-time cost of breaking the lease. We deemed that it was appropriate to assume a mid-period convention. Then our overhead synergy business enterprise value was $32 million for Synergy B. Next, for Synergy C, we took the wealth management division cost of services savings. We know that the 2025 cost of services was $26.8 million. Then going to our after-tax savings of $3.9 million, we again applied the new wealth management WACC and got to our cost of sales synergy of $75.1 million. Now, taking a look at the sum of the parts for NewCo, we do see here that the Crescent Oak CM division and wealth management division does have a new valuation value, and that is because of the adjusted WACC, which is adjusted for the decrease in size premium of NewCo. Then adding the precedent transactions and risk-adjusted synergies, we see that the business enterprise value for NewCo is $2.165 billion. Then to derive equity value, took away the net debt and the lawsuit liability to get to our equity value of $1.9 billion. And this derives our share price of $35.70 for the NewCo valuation. In the graph here, I would like to point out that the graph shows the de-risk potential from the merger because the capital markets division is going from 78% of the business down to 35%. So our conclusion here is that the expected merger price through option 1 of $45.70 is higher than the standalone of $43.26.
Awesome. So now I want to take us on analysis of option 2, which was the management buyout. So we understand this is going to be a fixed cash payment, $45, paid in 15 at close, and then 3 installments of 10 annually afterwards. So we've taken these cash flows and then we've discounted them back to the present value with a discount rate of 3.6%. The reason we've chosen the 3.6% discount rate is because the funds are going to be held in escrow. And because of this, the risk is lower as they're reasonably assured that nothing will happen to them. So we've taken the risk-free rate of the 3-year T-bill from the Government of Canada. And so this gives us a total fair market value in scenario A of $42.21 per share. Now, it's also important to consider that there's only a 70% chance that this transaction happens. So to account for the other 30% chance that this transaction does not happen, we decided to take the standalone Crescent Oak valuation to reflect, shareholders basically just holding on to their stock if the transaction falls through. And so by taking the probability times the fair market value per share of each of those scenarios, we come to a total FMV of option 2 of $42.53. And now to look at the share recapitalization scenario. So first we need to determine the amount of cash that needed to be injected to pay down debt and reduce to the optimal net debt to equity of 2.0. And so in order to do this, we use the leverage adjustment formula and determined that the number of shares required at a share price of $18 was roughly 4.9 million shares. And in order to validate our conclusion, we performed a back test on the right side of the screen, essentially just working backwards from our conclusion. And we successfully determined, once considering the debt paydown and the equity raise, that the net debt to equity would be 2. And so therefore, we've validated our conclusion. Now, for the dividend analysis in the share recapitalization scenario, so we've taken the new shares outstanding once we've added the new equity raise, taken the distribution per share that should be expected of $1.89 to determine the total cash required for the dividend payments. We've then taken the total CFAFD of both divisions, as we know that is kind of the criteria for our dividend payment. And then we've created the payout ratio by dividing total cash required for the dividend by total CFAFD. And then use an if function to determine when that ratio would be less than 90%, and determine that 2028 would be the first year the company could reinstate their dividend and then grow it annually at a rate of 5% per year.
So taking a look at all of these quantitative analyses as a whole, we've derived the base case from each of these options and have found that the NewCo base case of $45.70 is the best option from a quantitative standpoint. We can also see with the football field on the right-hand side that the NewCo option offers a low dispersion between our bear case and our best case, which we think is very favorable for our current shareholders. Now, taking a look at this from a qualitative standpoint, we believe that option 1 still offers a very high upside from a qualitative standpoint. So it offers a very high strategic fit that helps to de-risk Credit Oak. So this is super valuable for our existing shareholders. It also allows them to retain liquidity, which is super important when they're looking at this company moving forward in the future. And it does actually make the balance sheet ratio quite a bit healthier without having to do a ton of extra work. Now, we do see the one main disadvantage of this being the 35% ownership for Crescent Oak when we go through this merger option, but we think the quantitative as well as the qualitative upsides that we've identified outweigh this con and is actually going to be better for our shareholders in the long run. While the management buyout does offer cash certainty, that's only if it is successful, and it does have a 30% chance of management not being able to get the funds in order to fund this transaction. We believe that this risk is going to hurt our sentiment towards Crescent Oak if the transaction fails and continue to drop our share price, making it harder for our existing shareholders to realize the value within Crescent Oak. Finally, for share recapitalization, while there is a clear path to dividends, it doesn't actually fix the core business problem, which is that high capital markets division, and could lead to dividends being cut again in the future.
So when we consider the quantitative and the qualitative analysis that we provided you, we have Valuations LLP would advise Crescent Oak to pursue option 1, which is the Pinnacle Wealth merger. Now, before we get into the conclusion, we think it's extremely important to highlight that it is critical that Crescent Oak implement a vote among its existing shareholders to determine the company's course of action. And this is because the goals of existing shareholders may drastically differ, with some opting for immediate liquidity, such as in the MBO, or some wanting to participate in potential future upside with the merger. And so therefore, a vote needs to be held in order to best represent the interest of existing shareholders. For our rationale in selecting option 1, however, the key criteria was that it is the highest FMV per share for our existing shareholders. They can participate in that future de-risked upside. They have exposure to the potential synergies generated with Pinnacle Wealth. They're able to retain liquidity by remaining on the public market. They can have an immediate, it will have an immediate impact on their public share price with the news of the transaction. And they're able to negotiate their dividend policy, and they may even be able to reinstate it earlier than 2028. For key rationales against option 2 and 3, the main one with option 2 was a conflict of interest in the management buyout, because if management's implying that they can benefit on an upside from $42, we don't want our shareholders, they're essentially trying to capitalize on a depressed stock price. And there's also no participation for our shareholders in that future upside. With the share recapitalization scenario, as mentioned, it's simply just putting a band-aid on the company. It doesn't reduce the fundamental business risks. And we're also forfeiting synergies from option 1. And so lastly, what might a successful implementation plan look like if Crescent Oak were to pursue option one? So first would be capturing the synergies. And to do that, we have to make sure we take the easy wins, or that Crescent Oak takes the easy wins, and also protects that tax asset of the loss carry forward. In terms of addressing the people risk, they need to establish a retention pool to prevent star bankers from being poached. And also, we're running the CM division under a distinct boutique brand under their new corporate umbrella. And for the client communication plan, just making sure that's tailored between your WM clients and your CM clients, as the approach is going to be very different. And with that, I would like to pass it off to Maya to conclude this for today's presentation.
Thank you. So the key objective that we have addressed today is deciding which strategic direction Crescent Oak should pursue, with the main priority to maximize the fair market value per share for their existing shareholders. Our recommendation, based on our analysis, is to go forward with the Pinnacle merger to create NewCo, as this has the highest upside for the current shareholders. It has the highest base case share price of $45.70 and a number of qualitative benefits. Thank you so much for your time. We would love to answer any questions you may have.
Great work on the presentation, for sure. Two quick questions from me. So one of them was, you've
Curtis, you're pretty quiet right now. I don't know if
sorry,
others
is
heard.
this better now, or is it still quiet?
Yeah, thank you.
All right.
That's good.
Excellent. Yes, sorry, two quick questions from me. One, so you've recommended proceeding with the merger, and I like that you correctly identified a potential disadvantage being that loss of control. So I'm interested, like, to what extent do you consider this loss of control in the valuation? What led you to, include or exclude elements of this there?
Be happy to add to that. So thank you so much for the question, Curtis. So yes, we do understand that because they're losing control, it might be appropriate to apply a minority control discount essentially. In the valuation, we have not included any sort of discounts to account for the fact that they will now be minority shareholders in the new co. However, we think it's important to highlight that with proper negotiations, such as at the date of the transaction, and perhaps maybe advocating for additional board seats or voting rights on the board, that could help mitigate some of the impacts of having less of a majority share ownership.
Yeah, thanks. And I like that you included for the wealth management division that AUM sense check. So I'm interested if you talk again a bit about sort of your comp selection for the wealth management division, and overall, like, what your thoughts were again on the sensitivity and how the wealth management division compared to the comps.
Yeah, absolutely. I can take that. Maya, if you could open the comps analysis again, that would be great. So when we were looking at the comparables given by Pinnacle Wealth, we first wanted to identify that it is a small pool. So traditionally, we would like to look at more comparables moving forward. The ones we kept in were based on recency of those transactions, the amount of acquisition, as that is quite important when we're looking at our valuation. And then we also did account for using the median multiple, as we felt it's a better representation since we do see that RoboCapital is quite a bit lower. We did also do our own sensitivity to look at other comparables, so going through a Capital IQ and seeing recent transactions. We found a median multiple of 1.4 with our, looking into the industry. And so that kind of validated that 1.3% median multiple for us. And we felt that it was quite accurate, especially when we compared it to our CCF for the Pinnacle or for the Crescent Oak Wealth Management division.
Yeah, thanks. That's helpful.
First, I'd like to say great job on this presentation. I thoroughly enjoyed it, and it looks like you guys really spent a lot of time even going above and beyond with some external research. And it's really the external research that I'm curious about. I noticed in your case study about GE and also the comparables you were just looking at for EV over AUM, used Capital IQ as your external resource. I'm just wondering, were there any other external resources that you looked at for any of the analysis that wasn't sort of so obvious in the presentation?
Yeah, I can take that one. So when we were considering our specific risk premiums, obviously being quite a assumption that we had to derive, we wanted to look at similar WACC calculations within the market. When you are dealing with a specific risk premium, it is obviously based on that company's current scenario. So we found without that specific risk premium, we matched companies who maybe didn't have the same volatility that our organization had. And so that's what led us to that 5% evaluation. And then we did cross-reference that with companies similar to GE on what analysts were saying in their primers for a WACC. And that's kind of how we validated that number. So we used some external research for that side.
Right. And I had one other small question that relates to the discount rate that you used for your synergies. I think you said that you adjusted the WACC for the size premium because then it would be part of a bigger consolidated company. Were there any other risk factors that you considered in determining that that was the appropriate rate to use for those synergies?
Yes, that's a great question. So we did go forward with the size premium as the main driver of decreasing the WACC. And then when we looked at the specific risk premium, we did keep that consistent with the same ones that we used for the divisional analysis, because we did want to make sure that it was clear that the difference was based on the size premium.
Great. Thank you.
And just a couple for me. You guys did a great job. I really enjoyed your presentation. Yeah, it was laid out very clear. So yeah, very impressed. You guys should be proud. Just quickly on the specific risk premiums, I like that you included those and recognized that that was a subjective component of that discount rate. And just I noticed that you listed some of the factors on that slide as that were considered, one of them being shareholder liquidity. And I guess in that, were you kind of saying that because they are currently a public company that you would, okay. And so I guess just with that in mind, did you put any thought into the impact? Because it appears based on the case facts that they're quite thinly traded. And so did you consider how that might have any impact on the ability for shareholders to realize that liquidity?
Yeah, that's a great question and a fantastic observation. So we did kind of notice that it is quite thinly traded. Um, to compare it though to a private company, we still believe that, share owners of a private company, markets are extremely liquid, even more so than say public markets. When a stock is thinly traded like that, you can expect, for example, maybe higher spreads between bid and ask, for example, which might cause a problem for shareholders. And so while we didn't account for, the thinly tradedness, call it, of the stock, we do believe that it's still, is providing a lot more liquidity than just being in the private markets would.
Okay, awesome. That's a great answer. I don't have anything else.
Great presentation today. Thank you very much. Just wondering if you had more time, would there be anything you spend more time on changing the presentation at all?
I think honestly we were very happy with kind of where we came to. I think the next stage is looking at more into the implementation side of it. And then also I think we would have found it valuable to learn more about what the existing shareholders really value. So as per that note on the conclusion slide, we do understand that existing shareholders might have different perceptions based on how they want to realize the total value of Crescent Oak. And so digging deeper into that, I think we could have had a deeper implementation strategy.
Great, thank you for that. One more question. Looking at page 5, your WACC calculation, you have a cost of debt, SOFR plus 1%. Could you comment on maybe having a different, I guess, premium as opposed to 1% for each of the divisions? They are different. Just curious what your thoughts are there.
Sorry, can you just repeat the last part of the question once again?
Your cost of debt, you have a premium of 1% for both of the two divisions. I was just curious whether you had any thought of whether that number, that premium should be different between the two different divisions. They are different characteristics. Just wonder
Yeah,
about
no,
your thoughts there.
that's a great question. Just talking about the premium on the debt, perhaps we could have weighted it, a slightly higher premium to the capital markets division, seeing as though typically lenders, will be more, I guess, confident lending to kind of more stable, predictable companies with, kind of more predictable cash flow. For the capital markets division, because it's a lot more volatile, potentially there could be some work done to kind of, think about the premium and say, okay, well, maybe, does the capital markets kind of account for more of this premium than the wealth management division because of the nature of the business? So I think that might be an approach we could have taken, if we had more time.
Okay, great. Thank you very much.
Okay, it sounds like that's all the questions from the judges. So great work, Team 8. Excellent presentation. I'll now ask you folks to leave the meeting, and judges, I've been advised to let you know that you can actually move yourself into the breakout room. Should be one of the options down below. Maybe click more and see if you can find breakout rooms there.
Thank you guys very much.
Thank you so much.
Thank you.
Thank you, teammate.
And if you can't find that, I am here. Hello, Team 15, and welcome to day 2 of the BV Challenge. How are you doing?
Great. How about yourself?
Doing well, thank you. We have about 2 minutes till start time, but if one of your members of your team wants to go ahead and share their slide deck, they can do so now, and then we'll just wait for the judges to get back from their deliberations, and we can begin.
Cool.
I think we're just waiting for one of the judges here. How many members of your team are there, Gerline?
There are 3 people.
3? Okay.
Yes.
Hello.
Hi, Ryan. How are you?
I'm doing good. How are you?
Doing well, thank you. Third member of your team is not here yet as well.
He's just in the breakout room. I think he should be joining.
No problem. No problem. If we need to start a little bit after.
Oh, he's here now.
And there's Aaron. All right, if we can spotlight him. Thank you. So one of you can go ahead and start sharing your slide deck. And I'll hand it off to you. Good luck, Team 15.
Thank you.
Start whenever you're ready.
All right. Hello, judges. Welcome to our presentation. We are representing Valuations LLP. My team consists of Gerline, Aaron, and myself, Ryan, and we're here to talk about an analysis of the different strategic alternatives for Crescent Oak. So we're just going to start by giving just a brief agenda. We're going to start actually by giving you our recommendation and kind of a brief summary of why we picked each one. And then we're going to follow that with a quantitative and qualitative analysis of all 3 options. And then lastly, we're going to wrap it up with a brief conclusion. So starting off with our recommendation, based on all the different factors we've looked at, we believe that the best option for Crescent Oak would be the merger with Pinnacle Wealth. We believe this is the case because it allows shareholders to benefit from a larger platform that can provide more continuous revenue streams and better access to liquidity, while also unlocking the value of various synergies. We believe that the public market would view this larger, more diversified platform as a lower risk entity, which we would expect to command a 16% premium to the pre-announcement valuation of $55 per share for the Crescent Oak shareholders. And we believe the next best option would be the management group buyout, which of course presents shareholders with deferred cash consideration, approximately 18% below the pre-announcement valuation, again, $55. This valuation represents a 100% premium to the current share price of $20. However, on a deferred cash basis paid in installments, this is less attractive adjusted for present value. Additionally, this transaction also represents some uncertainty given a difficult financing environment. And then finally, we believe the least appealing option would be the share recapitalization. The company has the option to issue approximately 6 million additional shares at a 10% discount to the current market trading price, which can help deleverage the balance sheet. However, this would significantly dilute existing shareholders, and while it would reduce the debt, it would not allow the company to reintroduce a dividend until 2029, which you will go into more detail later. And we believe it's the least attractive option, as it is a very short-term solution that doesn't help in the long term. So now I'm going to pass off to Aaron to talk about option 1.
So option 1 was the Pinnacle Wealth Management merger, where we used a sum of the parts approach to value each of the entities which would merge into the new organization of NewCo. The analysis used a discounted cash flow forecast for the capital markets division of Crescent Oak, as well as a capitalized earnings valuation for the wealth management division, a precedent transactions valuation for Pinnacle Wealth, as well as an isolated DCF to value the impact of the synergies on the organization. So resulting from our analysis and valuation, the new enterprise of NewCo results in an enterprise value of $2.8 billion, as well as an equity value of $2.6 billion, of which Crescent Oak's shareholders will own a 36.5% share of $960 million of the equity value. The value derived represents a 220% premium to the current trading price of $20 and a 16% premium to the pre-announcement share price of $55. The new share price from the enterprise valuation is $64 per share. So going into first the capital markets division of Crescent Oak, the division is cyclical and volatile and grows well aligned with the industry. So given the forecast we were given for the IPO transactions, we used a discounted cash flow to value the capital markets division over the first 5 years. The revenue of the division was grown at the rate aligned with the IPO transactions in the market, and then costs were deducted accordingly to get us to our earnings before taxes. And after taxes were deducted, we made our relevant adjustments to get to our unlevered free cash flow resulting from the business over those 5 years. These free cash flows were discounted at the weighted average cost of capital pertaining solely to the capital markets division and summed with the terminal value, which we found by growing the cash flows outside of the model at a terminal rate of 3%, and again, discounting at the weighted average cost of capital. The sum of the terminal value at the valuation date and the free cash flows gives us our business enterprise value for the capital markets division of $977 million. We make our adjustments of adding our redundant assets of excess cash and preferred shares, again, pertaining just to the capital markets division, and subtracting debt allocated the same way to reach an equity value for the division of $788 million. Crescent Oak's wealth management division is quite different in their capital markets division in the fact that they are stable and predictable, so revenues don't fluctuate too much year over year. Given these facts, we decided to use a capitalized earnings approach to value the division. Operating income calculated based off Crescent Oak's revenues and expenses solely pertaining to the wealth management division were included. And then after-tax earnings were adjusted for non-cash items such as depreciation and multiplied by an earnings multiple, giving us an enterprise value of $270 million. The earnings multiple is an inverse of wealth management's capitalization rate, which is the WACC pertaining to that division, subtracting the terminal growth rate. The lawsuit mentioned in the case was a loss on an investor's misappropriated capital, which is an abnormal event. However, since this lawsuit was not paid yet, it did not materially impact the financial statement and was not included in our model. Again, the enterprise value of $270 million is adjusted for adding our redundant assets of excess cash and preferred shares pertaining to the division. And we then subtracted the debt for the division to give us an equity value for the wealth management division of Crescent Oak of $96 million. Colleen?
All right, thanks, Aaron. Now let's take a look at our next value added by the next segment. So for Pinnacle Wealth, our proposed merger partner, we valued the company using a precedent transaction analysis. Since Pinnacle is a private company and it doesn't really have detailed financial statements that are available to the public, we thought to use real market evidence from comparable deals. That would make the most sense here. So we took a look at 3 recent Canadian wealth management transactions from the precedent universe: Jupiter Capital's acquisition of Blue Green Asset Management, True North Co-Invest's purchase of Capital Corp, and Prosperity Partners' acquisition of Empower Wealth. These were all relevant because they had similar cost structures and business models, were recent enough to reflect today's pricing conditions, and they also happened in the same market or geographical region with the same regulatory environments and economic conditions. Now, it's also important to note that each one of these was a majority control transaction, which is very important because you pay a very different price for the control compared to a minority stake in a company. So control deals include a premium, as we all know, because the buyer gains full strategic decision-making power. Now, across these deals, the valuation multiples range between 1.5% and 2.3% of assets under management, which is shown in our chart over there, came to an average of around 1.9%. We applied that 1.9% multiple to Pinnacle's $80 billion in assets under management, which gave us an enterprise value of around $1.48 billion. Now, overall, this gives us a clear market-driven estimate, which reflects what strategic buyers have actually been willing to pay for comparable wealth managers in Canada. Now we'll take a look at the synergies from the potential merger between Crescent Oak and Pinnacle Wealth. Most of the synergies here come from 3 areas. So firstly, cost savings from overlapping corporate functions. Secondly, operational efficiencies through shared technology. And then thirdly, the tax advantage from Pinnacle's $25 million in loss carryforwards. So we didn't isolated discounted cash flow here. We projected the cash flows from these synergies over 5 years. We adjusted for the integration costs, and then we discounted them using Crescent Oak's 8% WACC with a 2.5% terminal growth rate. The result was a present value of around $104 million, made up of roughly $27 million from forecasted cash flows and then $77 million from the terminal value. So overall, these synergies really strengthen the financial case for the merger. Now, we need to take a look at why the share price is so different. One of the key questions we wanted to address is why Crescent Oak's share price was around $20 at the valuation date, while our analysis of the capital markets and wealth management divisions points to an intrinsic value of around $64 per share. When we combine the two divisions, we get an enterprise value of roughly $1.25 billion. And then after we adjust for the $66 million in redundant assets and $350 million of net debt, that works out to an equity value of around $964 or $64 per share. So you might be wondering why the big gap. So some of the key drivers of the market undervaluation would be, firstly, the market has been very overly pessimistic after the dividend suspension, of course. And then the short-term weakness in the capital markets division also adds to that. Secondly, investors are assigning a very high risk premium because of the earnings volatility and leverage. And then thirdly, the steady performance of the wealth management side is being severely overlooked. Finally, the stock faces a liquidity discount. With only about 15 million shares outstanding, it doesn't really attract large institutional investors. Now I'll pass it off to Ryan.
Thank you, Gurleen. So again, we're here to look at also some of the qualitative factors as to why we believe the merger is the best option. So some of the advantages are that the shareholders still retain some value. They can maintain equity participation in a now stronger and more diversified platform than before. Additionally, the merger provides access to, again, diversified and stable cash flows from both the Wealth Management Division and Pinnacle Steady Earnings, which can reduce reliance on the very volatile Capital Market Division, which can lower the perceived business risk. In addition, this improved liquidity can improve financial strength and support balance sheet stability and future dividend recovery. The increased scale can increase market confidence, which can provide growth in the future. As well, the realizable synergies provide the meaningful cost savings from overlapping operations and enhance cost efficiency. However, this option obviously isn't perfect. There are some disadvantages. As mentioned, the Crescent Oak shareholders will hold only 36.5% of the new entity, which means they lose majority ownership and voting power. Additionally, there are potential merger risks to account for, such as challenges from merging operations, technical systems, company cultures, as well as exposure to unknown liabilities and hidden costs. Additionally, this transaction that could be very complex and could extend the timeline and result in high advisory costs. And then finally, the short-term uncertainty that can come from a merger where the temporary disruption among integration can affect both companies' performance as well as market sentiment. I'll now pass it off to Aaron to talk about option 2.
So option 2 consists of the management buyout of Management LLC pertaining to Crescent Oak. The buyout consists of a $15 per share payment 6 months after the valuation date, and then 3 equal $10 payments thereafter. We outlined these payments on a forecast and then discounted them back to the valuation date at Crescent Oak as a whole's weighted average cost of capital. This was found at their cost of equity at 14% and their cost of debt at 5% to give us a WACC of 8%. Discounting these $45 total cash flows that back to the present gives us a present value of the cash flows of $39 per share. Again, we have to account for the 70% probability of receiving these payments, which after that is accounted for, it gives us a expected fair market value per share of $27.60 per share. I'll pass on to Ryan.
All right, so I'm now talking about the qualitative factors for our second best option, the buyout. So first advantage is the premium offer, which again, providing the shareholders with a nominal cash return at $45 per share, which is well above the current market price of $20. This certainty of value can help eliminate exposure to market volatility and future dividend uncertainty. A very large advantage is now that Crescent Oak will be going private, they can now operate on their own terms and their own timing without short-term investor expectations or scrutiny from the public market. As well, the strategic alignment from management ownership could lead to greater operational focus and long-term strategic execution. However, there are some disadvantages as well. As the shareholders now have 0% stake in the company, they forfeit any potential gains if the company's performance were to improve post-buyout. As well, while the nominal payments sound great, because only $15 paid up front, with the rest spread out over the 3 years, this reduces the value due to present value back to current. As well, the financing execution risk. As mentioned, there is estimated at a 70% chance that the transaction even happens. And if it doesn't, that could be very detrimental to the company. And then finally, the lack of liquidity, as again, shareholders receive no future participation in the private company. So I'll pass off to Gurleen to talk about option 3.
Thanks, Ryan. The next and final alternative that my team and I looked at was share recapitalization. So in this scenario, Crescent Oak would issue about 5.9 million new shares, which would raise roughly around $107 million to pay down debt and bring the debt to equity ratio back or closer to 2 to 1. This would improve liquidity and reduce leverage, but we have a very big issue here, which is dilution. New shares would likely be priced at around $18, which is well below the pre-announcement level of $55. That means existing shareholders would see roughly 30% dilution, and the overall valuation gain would be very limited. So even though this option strengthens the balance sheet in the short term, it doesn't actually address the underlying profitability or valuation gap. It's more of a temporary fix than a long-term solution. Finally, as part of the recapitalization review, we also tested whether Crescent Oak could realistically reintroduce dividends under that structure. Yeah. So based on our forecasted free cash flows, after accounting for interest and capital requirements, the company wouldn't meet its dividend coverage threshold until 2029. Now, using the company's 90% payout policy, that would translate to about 9% yield on today's share price once reinstated. But the key point here is that there would be no distribution for the next 4 years, which is not a great look on the company. So even though the recapitalization slightly reduces leverage, it doesn't deliver meaningful shareholder returns anytime soon. So this reinforces that strategically, recapitalization just isn't a value creative path for Crescent Oak. Ryan?
All right, thank you. So now, again, talking about the qualitative factors for, again, we believe is the least appealing option. Start with some advantages, of course. Improved liquidity. Again, the injection of a large cash flow can provide short-term liquidity needs and can improve financial flexibility. As Gurleen mentioned, the proceeds can be used to reduce the leverage and bring the debt to equity ratio back in line with industry standards of 2 to 1. Additionally, the shareholders would maintain the current ownership structure of 100% control and voting rights. And then finally, the proceeds from the capitalization could have the potential to be reinvested back in the company to support future strategic investments once liquidity stabilizes. However, as we mentioned, there are significant disadvantages, including the share dilution. Again, some investors own shares at $55, but they're now being issued at $18. Again, the very temporary solution is putting a Band-Aid on a broken bone, essentially, if you look at it. It addresses liquidity issues in the short term, but doesn't fundamentally enhance any long-term profitability or stability. I just want to reiterate the importance of the dividend delay and how detrimental that could be when the value dropped by almost 60% when it was delayed for 1 year. If it's being delayed for another 4 years, that could significantly lower investor confidence and could depress the share price even further. And then finally, the debt repayment risk is still there. It has to be paid by 2031, which could create further refinancing and cash flow pressures. I'm going to pass off to Aaron to wrap it up.
In conclusion, we have decided to move forward with option 1 of the Pinnacle Wealth merger, as this provides the highest fair market value per share of $64 per share and the most value to shareholders. The long-term viability and upside is high due to the merger. There is 100% certainty of the transaction closing, notwithstanding any external options. And in terms of shareholder perception, they lose voting control in their 36% minority share. However, this is still a longer-term prospect as it is a higher share price, giving more value to the shareholders. Thank you. And if you have any questions, we are now open.
Great work on the presentation. 2 quick questions from my end. So first, you identified the lost control under your recommendation. So I was interested in getting your thoughts on to what extent you consider this reflecting something in the value from that perspective.
Sorry, if we considered that the loss of control, if we included something that would impact the model and directly impact the value, is that your question?
Like whether or not you considered for example, a minority discount, and if you did or didn't, why?
Yeah. I can take that one. So we did consider implementing a minority discount to our valuation for the 36% share. However, although still a minority, we found that it wasn't significant enough of a minority to actually quantify a lower share price. As 36%, although not majority, it's still a significant share in the company, and we found it would still be valuable to shareholders to own this share in the merger.
Yeah, got it. And otherwise, I was interested if you prepared any sort of external research in excess of what was provided in the case for this analysis, or did you mostly stick to the case facts?
Yeah, we did mostly refer to the case facts as that was like the most readily available information that was credible to use. So that's what we mostly referred to.
Yeah, thanks.
Thank you very much for your very in-depth analysis and the great presentation you provided us today.
Thank you.
I have a question about the management buyout option. I think on slide 12, you indicated that there was one of the advantages of that option was that there was a certainty around the value. And I'm just wondering why you still use the company's overall operating WACC when there was this certainty of value that you identified in your advantages here. Did you consider using any lower rate in your analysis? And if you did, why did you choose what you chose?
I'll say, I guess we chose to use the company's overall WACC as we thought it was appropriate for the most part to discount the value to the present value as it accounted for the company as a whole. The adjustment we did make was regarding the 70% probability, which actually reduced the share price because of that uncertainty in that aspect. Going back to your advantage question here. Yeah, I guess it was just the full WACC we decided to use.
Yeah, sorry, I would like to add that we did consider using other discount rates, but we thought it would be most appropriate to use the WACC. So we did have some discourse over that, but we stick to the WACC in the end.
Okay, thank you.
And yeah, just a couple questions from me. Great job, guys. I noticed on your final slide, like your conclusion, you have certainty of transaction close. And for option one, the Pinnacle Wealth merger, it's 100%, but with a asterisk next to it. And then the same thing with recapitalization, it's approximately 100%. Like, what are those what do those symbols mean to you, I guess, and what were the considerations around, the risk of close for each of those options?
So I can take this one. So again, when we're given the information in the case, the only fixed like certainty or value we had was for option 2. So then for option 1 and 3, we wanted to assume that they would happen, but we also wanted to understand that in the real world, things don't always go exactly as planned. Again, with the merger, as mentioned, there are several risks. Like there could be some unknown liabilities that could happen, which could potentially mean that Crescent Oak might want to back out. Or for the recapitalization, maybe when they issue the shares, the confidence has decreased the price even further, so people don't want to. So I think based on the case, we tried to keep it 100%, but we also wanted to acknowledge that there are other external factors that we can't always predict for. So that's why we decided to have a little asterisk just to show that there are things that we can't always predict for. We can try, but there's always going to be something that could come in the way.
Okay, yeah, no, that's great. I think that's it from me.
Thank you for the case. Good job. I was just wondering how many hours you worked to put this all together. We got to put a bill together for the client. And I was just kind of curious how you logistically allocated the work amongst you.
All right. I'd say I can take this. We started working or reading through the case once it was released, kind of working on it on our own and then figuring out like how to go about it and what options would seem like the more favorable ones. And then Sunday we had to double down and work on it all the way from the morning to the night and then put together our financial model, continuously edit that, figure out what types of valuation methods we would use based on the facts given, and what would be the most appropriate. And then from there, after we kind of did our analysis of all the parts and all the different segments and the value that they would add, we decided to go with option one and go with that as a recommendation. From then, we started kind of structuring our slides and then editing as we go. So that's kind of how we did this. And then, yeah, I would say that we all put in as much effort as we could. I mean, obviously, we have other commitments as well. Like we had midterms and like a whole bunch of crazy stuff going on. But in the end, it all came together, and I'm proud of us for the work we put in.
Plus the Blue Jays. Any challenges in terms of where did you see the challenges in putting your work together?
Sorry, Aaron, could you go to like the appendices? Maybe appendix like 9 and 10. Yeah, so we did have some discourse over like which option would be the best to begin with because we weren't particularly done our financial models. So we did have like other considerations. Like we didn't really get any questions about this, but we prepared some appendices, like what would need to change about the management buyout, or what would need to change if you go to the next slide, for the share recapitalization, for it to be a better option. So these are some of the things that we discussed, like there's limit, like there would need to be a more transparent use of proceeds, for an example, to restore like investor confidence. And then also a more like upfront cash for some of the options, um, which would make those options more favorable. So we just had some like debate about like which option would be better and why. So I feel like that really like strengthened our analysis and like helped us understand why the merger would be the best option.
Yeah, if I could just add on it, because for all of us in our group have a lot of accounting experience. And so some of the stuff in this case was quite new to us. And so it was definitely cool having like a learning opportunity, having to take a very different approach from this. Again, we're not as experienced with finance. We have some, but it was really cool learning how business valuation works and seeing how it can overlap with accounting and valuing a business. So I think a challenge was definitely kind of learning how this works. But I think we learned a lot, and it was a really cool experience to have.
Unlocked a new skill set.
Exactly. Yeah.
And to add on to that, we initially looked at the case each on our own, and of course we come to certain different conclusions on some things. And through discourse and kind of seeing it from a different perspective from each of us, we're able to come up with a solution which we presented to you, which we all agreed upon.
Learned a lot.
Yeah.
Great. Thank you for that. I don't have any additional questions.
That's excellent to hear. Thank you, judges, and thank you, team, for your great presentation. Really appreciated having you guys. You did an excellent job.
Thank you.
You guys can drop off whenever you're ready, and judges, you can head on over to your breakout rooms.
Thank you, judges. Have a great rest of your day.
Thank you, guys.
Thank you,
Good
Team
job.
15.
Wish all the best.
Bye.
Welcome, Team 16. We're going to get started shortly. If one of you wants to go ahead and share your slide deck, we can get you set up to get started here.
Oh yeah, for sure. Thank you, Kevin. Can everyone see my screen all right?
I can see it.
Perfect.
How are you guys doing today?
We're doing great. How are you?
Good.
Doing great.
Excellent. Yeah, I'm doing well. It's been a day full of really great presentations, and I'm sure you guys will add to that. I'm just gonna check in on our judges here. I see we're just waiting on Michael, so we'll give him a sec. Oh, there he is. Excellent. Okay, well, Team 16, with that, I wish you best of luck, and I'll hand it off to you to begin your presentation.
All right, thank you so much. Good afternoon, everyone. My name is Sach, and I'm joined by my colleagues Jack, Pratyush, and Tim, and we're so excited to present our recommendation of how Crescent should move forward considering their options along with our valuation. Diving right into our executive summary, we are going to be starting off with some overview of this engagement, our valuation of Crescent Oak, analyses of the merger, buyout, and recapitalization options, some strategic considerations, as well as our final recommendation and our conclusion. So we are going to be recommending that Crescent Oak merges with Pinnacle Wealth to form NewCo, as this option yielded the highest share price of around $47 with an upside of 135%. In contrast, the buyout offer yields a price of around $28 considering financing risk, and recapitalization yields around $36 per share, but also dilutes existing shareholders among other issues. The merger value drivers include the annuity earnings of Wealth Management Division, the rebound potential of the Capital Markets Division, the scale of Pinnacle Wealth, as well as quantifiable synergies. Moving on to our tasks, firstly, we will be looking to value the Wealth Management and Capital Markets divisions of Crescent Oak, determine a fair market value of Pinnacle Wealth and merger synergies, determine a fair market value of the management buyout and consider downside cases, and finally determine a fair market value of the share recapitalization. Before we dive into financials, we did want to take a look at some qualitative factors for each of these options. The merger option has medium to long-term total shareholder return time horizon and shares risk with Pinnacle Wealth. It has durable value creation from synergies and scale, but has integration risks. The management buyout offer offers near-term cash certainty to shareholders and shifts all risk to the management group. It has a clean exit price assuming financing can be secured, but foregoes shareholder upside in the case that the capital markets division begins to thrive. Finally, the share recapitalization has a medium time horizon with all risk being in-house. It preserves public upside and control, but the dilution transfers option value to new money. With that, I'll pass it off to Jack to look at our valuation.
Thank you, Sach. Let's now examine the assumptions we have applied to our model to calculate the weighted average cost of capital. We valued Crescent Oak as of August 31st, 2025. To reflect the distinct risk profiles of each segment, we used separate WACC calculations. 7.9% for wealth management and 8.3% for capital markets. These incorporate a 4% 20-year Canadian Treasury yield as the risk-free rate, a 6% market premium, a 4% size premium for Crescent Oak scale, and we have applied the optimal 2-to-1 debt-to-equity capital structure weighting in our WACC. The discrepancy in WACC comes from the differences in equity risk premium of 5.4% for wealth management and 6.6% for capital markets. Now, let's go over some of the key business growth assumptions we have for each arm of Crescent Oak. Driving our wealth management is the growth of asset under management, which we have projected to grow at around 2.8% year over year, in line to the growth rate of the past 4 years. The cost for wealth management, including compensation, cost of service, and corporate overhead, also grows at a steady pace of 2.5%, aligned with the inflation. Moving on to capital markets, this year the market is seeing a strong recovery for M&A and financing activities. We expect a significant increase in the amount of deals, starting off strong with 35 transactions in 2026, as well as a yearly increase of 4% in average transaction volume. From that, we collect base fees of around $1 million and a performance fee of 2% per deal. This nearly doubles our projected revenue within 1 year, from $95 million in 2025 to $175 million in 2026. The main cost drivers for capital markets is compensation at 55% of revenue, as this is a highly competitive field requiring significant investment in human capital. The cost of service, corporate overhead, and depreciation for capital markets are similar to the structure and growth of our wealth management business, along with inflation. As capital markets is the segment with more financing need, we have incorporated the entirety of interest payment onto the capital markets business. Now onto the valuation, starting off with the wealth management division. We know the industry to be stable and predictable. As we can see from the steady growth in EBIT, we adjusted for dividend income from the UK wealth manager, which is not a part of our business, as well as adding the tax shield from the undepreciated capital cost remaining on our balance sheet. We used the wealth management WACC of 7.9%, a terminal growth rate of 3%, and through a perpetuity discounted cash flow, we're able to arrive at a net present value of around 260 to 300 million. Looking at capital markets now, an industry that is cyclical, volatile, but is poised for an explosive recovery. We adjusted for the working capital needs as 4% of revenue and added back the rest of the tax shield applicable to capital markets. Using a WACC of 8.1% and a terminal growth rate of 3%, we're able to arrive at a net present value of around 850 million. This industry is highly dependent on the deal volume in the Canadian market, as well as your capital markets arm's ability to capture 10% of that very market. After testing for sensitivity of the inputs, including the WACC, terminal growth rate, and deal counts, we deemed the enterprise value to be between $800 to $900 million. Now the question is, if we proceed with a merger, what is the fair market value of Pinnacle Wealth? Due to the fact that Pinnacle Wealth is not a publicly traded company, we were not able to reliably obtain or estimate its earnings figures. So we have decided to use a precedent transactions approach to best approximate its value. We have selected the acquisition of Blue Green Asset Management, Empower Wealth Group, and Coinvest Capital to be our reference point. This is because, firstly, they're predominantly focused in the North American equity markets with a client base consisting of retail and institutional investors, just like Pinnacle Wealth. They were the closest in figures when it comes to assets under management. And lastly, they were all majority stake acquisitions, over 90% transacted within the last 3 years. The same reasons reflect our decisions to forego the rest of the transactions due to misaligned characteristics. Using a mean EV to AUM of 1.11%, we arrive at an implied enterprise value of $840 to $920 million for Pinnacle Wealth. Now, proceeding with the merger, what are some synergies that we can expect? Management has given us guidance of around 10% reduction in corporate overhead from consolidating our Indian support office and 20% cost of service reduction for wealth specifically. We recognize that realistically, synergies take time to realize and they take investments to implement. We have estimated a 2-year ramp to fully unlock our cost savings, as well as setting aside 10% of the present value of total synergies towards implementation, eventually arriving at a net present value of adjusted synergies of $120 million. There are also some important one-time non-recurring synergies and costs we have to adjust into our final valuation of NewCo. This includes the lease termination of the Indian office of $3 million, a $6.75 million tax shield from the tax loss in Pinnacle's former investment banking arm, which we can apply to our future capital markets earnings, a lawsuit costing up to $6.11 million, including losses, refund fees, and misreturns. And lastly, our ownership of the UK wealth manager at an adjusted market value of $7.14 million. Putting all these together now, what is the fair market value per share for NewCo? First, by consolidating the equity value of Crescent Oak at $836 million, Pinnacle Wealth at $964 million, and the present value of synergies at $120 million, we arrive at a combined equity value of $1.92 billion. We then adjust for the one-time non-recurring synergies and costs totaling up to around $5 million. This represents a final equity value of around $1.92 billion. Of that $1.92 billion, 36.5% is available to the former Crescent Oak shareholders. Although 36.5% is a minority, this case does not grant the need for a minority discount, since NewCo will be publicly listed, meaning immediate liquidity to shareholders. Finally, dividing the 734 million equity value proportion by 15 million shares, we arrive at the fair market value per share of $47, a staggering 135% return from the current share price of just $20. Now that I have concluded our merger model to form NewCo, I will pass it on to my colleague Pratyush to discuss the management buyout.
Thank you, Jack. So Management LLC is a special purpose vehicle created by the management team of Crescent Oak to acquire the company. The buyout is structured throughout a 4-year deferred payment plan, consisting of an initial payment of $15 per share, followed by 3 consecutive annual payments of $10 per share. Since these payments are held in escrow, we must account for both the 3.6% escrow fee and a 14.3% cost of equity to properly discount these future payments to their present value. After applying these discounts, the nominal $45 per share offer translates to a present value of around $32 per share for the shareholder. We then layer in deal completion risk, assuming a 70% probability of success and a 30% probability of failure, with the failure scenarios represented by the current share price of $20 per share. Adjusting for these probabilities results in a risk-free adjusted present value of $28.5 per share, meaning that once escrow costs, time value, and transaction risk are considered, shareholders would effectively receive just under $29 per share. Moving on, we assess the financing and debt implications of the buyout itself. The total funding required for this MBO amounts to approximately $675 million, which represents the $45 per share offer across 15 million outstanding shares. This deal is financed through a 70% debt and 30% equity mix, which adjusts Crescent Oak's post-transaction capital structure to approximately 79% debt and 21% equity. This structure results in $472.5 million in new debt, carrying an interest rate of 7%, with annual principal repayments of about $50 million over a 10-year timeframe. In the early years, interest expense is substantial, resulting in interest coverage ratios of only 1.8 times EBIT in 2026. However, as debt is gradually repaid and EBIT increases, this ratio improves to 5.2 times by 2029, reflecting steady deleveraging and stronger free cash flow generation. Our interest sensitivity table analysis further illustrates that while the transaction remains feasible at moderate rate increases, it becomes notably tighter at higher rates, underscoring Crescent Oak's exposure and exposing it to financing costs. In conclusion, while this MBO grants management greater control and long-term ownership stability, it leaves Crescent Oak highly leveraged in the near term and exposes shareholders to reduced value realization due to deferred payments and escrow deductions. With the effective payout declining to $28.5 per share and expectations of a broader recovery in capital markets, shareholders may be better positioned to hold their shares rather than accept the buyout at this discounted valuation. I will now pass it on to Tim to walk you through our share recapitalization model.
Thank you, Pratt. Now let's take a closer look at the other option, the share recapitalization that Crescent Oak has with the purpose of achieving a debt-to-equity ratio of 2-to-1 and to reinstate dividends while also estimating the fair market value per share under a standalone recap. Shares will be issued at a 10% discount from the current price of $20, so at $18 per share. The determining lever we used is ending cash. Once we choose the ending cash target, the equity raised is pinned by the leverage constraint. The current debt we have is $350 million, but increasing the equity while simultaneously decreasing debt will allow for you to issue less shares so you can avoid unnecessary dilution. The new equity was calculated with the initial equity plus the equity raised, and the new debt was calculated from the initial debt minus the current cash reserves minus the equity raised plus the ending cash, which we want to keep. Across the ending cash options, our model produces internally consistent sets of equity raised, share outstanding, new debt, and interest expense, with that interest expense based on the 7% interest rate of the secured overnight financing rate plus a 1% premium. Targeting the debt with the new equity, we can reduce the lender risk. It's important to note that retaining too much cash can be viewed as wasteful idle capital, but you still need a buffer larger than the regulation minimum of $10 million. Using the raised equity to solely pay for the dividends is also frowned upon because investors expect organic payments using the cash flows available for distribution. The dividend price on the right is also the payment Crescent Oak would have to make in its first year should you reinstate dividends at a price of $1.89 per share multiplied by the new total amount of shares issued. Moving on to choosing the best ending cash option for the share recapitalization, we tested 6 different points on the curve with $60 million ending cash or $105 million equity raised as the rational equilibrium. $30 to $45 million give Crescent Oak too tight of liquidity and unsustainable dividend payouts, even if the interest becomes lower and there is less dilution. On the other extreme, $75 to $105 million ending cash has excess liquidity with sustainable dividend payouts, but the dilution is higher and the interest rates are still high. Raising $105 million in new equity is the perfect middle ground, issuing 5.81 million new shares, however, still diluting our existing shareholders by 27%. At a new debt of $239 million, your new interest payment is $16 million per year, and your new dividend payment for the first year would be $39.3 million. To look at dividend increase feasibility, we wanted to first look at calculating the cash flows available for distribution from EBIT minus interest expense and tax, canceling out depreciation and capex, and lastly, subtracting change in working capital, we have our cash flows available for distribution. If the dividend payout is less than 90% of the cash flow available for distribution, Crescent Oak can increase dividends by 5%. We can see that in the first 3 years, that it will require us to pay a portion of dividends with the cash you currently have. However, the amount we have remaining is still sustainable, and you can eventually increase dividends by 5% a year starting in 2029. It's important to know that under this option, your cash flow available for distribution continues on with normal, no change in revenue or margins, except for the fact that new debt interest expense being lower. Now let's look at calculating a fair market value per share for Crescent Oak after the share recapitalization. Using a weighted average cost of equity of 14.3%, because we already adjusted for the interest expense, and a terminal growth rate of 3%, we use the perpetuity growth method with the terminal free cash flow to get a terminal value of $1.138 billion. Discounting that over 5 years, we arrive at a terminal value of $583 million. Adding up the cash flows, we calculated the EV to be around $704 million. Because this is levered cash flow, we add on the current unrestricted cash to arrive at our equity value of $754 million. Divided by the two new total shares of 20.81 million, we get a share price of $36. With our sensitivity table for ending cash, we can see that share price for $60 million is slightly lower than the $30 to $45 million ending cash case because retaining more cash requires issuing new shares and slightly more dilution. However, if we chose that option, we would not be able to sustain the dividend reinstatement in the first year. Our fair market value range is around $30 to $40 per share, adjusting for the best and worst case scenarios that may change the wealth management and capital markets growth, and therefore also our cash flow and equity value. This positioning allows a firm to communicate to investors that Crescent Oak is simultaneously restoring dividends, meeting its 2-to-1 debt to equity target, and maintaining a fair market value per share. However, with no additional operational uplift to the income. I'll now pass it off to my colleague Sach with our recommendation.
Thank you, Tim. Now that you've taken a detailed look at the financials, we want to give a final overview of these options as well as our recommendation. With the highest fair market value of $47, the merger seems the obvious option, but there are more factors that make it the best option for Crescent Oak. The main reason you are considering any of this is because of the short-term liquidity issues and the issue of the capital markets division being so cyclical. Pinnacle Wealth has the scale to stabilize these earnings with their wealth management segment, and there's additional value from synergies. In contrast, the management buyout actually loads more debt onto the company, along with additional risk from financing and escrow mechanics. The share recapitalization does solve the short-term liquidity issue, but in the long run, this same issue could arise considering that capital markets will continue to be cyclical. With this in mind, we recommend that Crescent Oak merges with Pinnacle Wealth to form NewCo. There are 4 key risks with this merger: integration slippage, wealth management client and advisor churn, governance misalignment, and tax loss monetization shortfall. Of these, we want to emphasize 2. While the merger does have a lot of value through synergies, there is a risk that these could be delayed, weakening our dividend case and creating multiple compression. The mitigation for this focuses on creating an integration management office that would have clear deadlines, owner accountability, and monthly reporting on cost savings. This would be funded by cash set aside that was considered when we built the merger model. The second risk is associated with client and advisor churn, assuming that some may fear that changes could be made to the wealth management division. Even a small percentage of lost assets would materially reduce long-term revenue. To mitigate this, you should begin proactive outreach before the deal closes to reassure clients that pricing and service levels will not change. You may also publish a public service continuity pledge to remove any uncertainty. Let's take a brief look at an implementation timeline towards a new co. During the deal prep phase, you will be signing and announcing the transaction, acquiring the needed approvals, and setting up the aforementioned integration management office. Next is some risk control. You should validate the viability of the $25 million tax shield, begin outreach to clients and advisors, and resolve legacy issues like the wealth management lawsuit. Finally, after the deal is closed, you'll be setting up governance, consolidating the Canadian and Indian operations, and planning out synergy realization. To conclude our presentation, we are recommending that Crescent Oak merges with Pinnacle Wealth, as this option yields the highest fair market value per share at $47 with substantial synergies. The buyout offer does seem attractive at first, but considering the financing risk, the payoff is only $28. The recapitalization does boost debt ratios and dividends, but leaves market undervaluation unaddressed. As we stated previously, the NewCo merger does offer the strongest long-term value, both in terms of shareholders and in terms of company viability. Thank you, and we will open the floor for questions.
Great work on the presentation. My first question is, so you did correctly identify that there will be this minority stake in the merge co, and you elaborated on some of the sort of risks related to that, as well as some mitigants. But I'm interested on your thoughts. To what extent do you consider, for example, a minority discount in your valuation versus to what extent the mitigants sort of offset that?
Yeah, for sure. Let me just move on to the right slide. I believe it would be here. So I did touch up briefly on the minority discount. However, we believe that this 36.5%, it's not the ownership for a private company. That would imply a discount. Our thought process is that it's a publicly traded company. There is liquidity in the market. There are buyers and sellers transacting each moment, and our shareholders would not have to pay for a minority discount due to this liquidity.
Yeah, and then on the current market price, so currently we have this, substantial reduction in value. We're at $20 a share, and naturally that's a lot lower than the fair market value you've calculated. So I'm interested, like logically, why would there be this difference? Why is the market at $20 when the real value's much higher?
Thank you, Curtis. That is an excellent question, and it does raise some eyebrows on why the share price currently is only $20, considering the intrinsic value could be up to $30 or even $40. So one of the main reasons we believe is that we are just coming out of a post-high interest rate period with low market sentiment on financial services, and we are starting to see investors getting more and more confident with these stocks. So we expect the $20 to grow, the share price to grow significantly along with the index. As well, we have just announced the cancellation of our dividend, which would be a huge negative catalyst in terms of share price. That would put a lot of negative sentiment on the stock momentarily. However, as people start to pick up the confidence and realize the true value of Crescent Oak and even the merger with to form NewCo, they will start to price those differences in.
Yeah, great. Thanks.
Hello, Team 16. Great job on your presentation today. I have a question, or maybe even a few, we'll see how it goes, about the management buyout. And I was just wondering, I noticed on this schedule, I think it's the next one, you've got the financing debt repayment schedule. And I'm just curious, does the price that you've come up with, does it consider that this debt repayment, the interest is paid actually by the company, and so the market price is reduced for that? Or I'm trying to understand why this analysis is here and how it factors into your analysis.
Yeah, that's a great question, Evelyn. So essentially what that debt repayment schedule is looking at whether we can sustain that amount of debt and how it affects our free cash flow. So essentially seeing like how our free cash flow behaves when we take on that amount of debt in this management buyout, and to see whether we can even sustain it in the short term or the long term. So as you can see, we have like our interest coverage ratios there as well, which kind of showcase the fact that slowly we can start to sustain that debt more evenly. And at the start, we're very like leveraged to that debt. That's what the table is primarily showcasing.
Okay, so you're considering that the company itself, rather than Management LLC, will be paying these costs?
Yes. So in the MBO presumptions that we had were that the debt would get passed on to the company then when Management LLC buys the company.
And where did that assumption come from?
So that assumption was from some other case studies that we had as well. So one of them were from Seagate Management. So that's also where we sort of saw when they passed on debt to the company itself, because when the Management LLC buys it, they pass on some of that debt to sort of see how that debt goes into free cash flow in the future as well.
Oh, okay. Thank you.
Yeah, great presentation, guys. I had similar questions on the management buyout. Just more kind of, if we're advising the current shareholders, if they kind of sell, if they're just receiving cash and they're fully out of the company, it's almost like, why would they care at that point? But I do see where you guys were going with kind of looking at the company's health overall. I did have a question on, I guess, on your recapitalization, and it could just be me not following it. But so in each of these scenarios, like, can you just walk me through the top table a little bit there?
Yeah,
Sorry, the
for sure.
previous slide. Yeah.
This one? Okay.
Yeah.
Yeah. So what we used was the ending cash as our lever to determine how much equity we want to raise to achieve the debt to equity ratio of 2. So based on, the current debt of 350 million, we looked at if we're using our equity raised to pay off that debt, we can both reduce debt and also increase equity at the same time. So the new
Okay.
equity would be calculated by, the initial equity plus equity raised, and the new debt would be the initial debt minus the current cash reserves we have, as well as the equity raised, as well as how much ending cash we want to be left with to, possibly reinstate the dividends. So that's what the table on the top shows. Basically, the ending cash is the determinator for how much equity we want to raise, as well as what the new debt will be, and also just focusing on the debt to equity of 2 to 0.
Okay. So like in some of these scenarios, then do you exceed the debt to equity ratio of 2 to 0 or not?
No. The ending cash
Like
will
you.
ensure, yeah. So
Oh,
the equity
okay,
raise
okay.
will
I,
like
I see
adjust.
what you're
Yeah.
saying. So then as far as that goes, like what was your considerations upon like having extra cash to like reinstate the dividend versus like the impact of issuing more shares and therefore diluting existing shareholders?
Yeah, so there were a couple issues with the lower cash amounts from 30 to 45 million, as well as the higher on the other end, the 75 to 105 million dollars. Raising more would have, more liquidity, as well as also sustainable dividend payouts, but the dilution is a lot higher and the interest rates are still high because we don't use that money to pay off the debt instead, and instead we have just idle cash that's sitting around just to pay off the dividends. And on the other end, 30 to 45 million dollars would be a little too tight on liquidity with unsustainable dividend payouts. We chose 60 million as the perfect ending option to, have that buffer for the dividend payouts, but also, not dilute our shareholders to the extreme and still have, enough cash where it's not idle.
Okay, thank you.
Yeah.
That was all I had.
Great. Thank you very much for putting the case together. Great job. I'd like to know where you see the challenges in terms of putting this case together for the event, and could AI have helped you?
Yeah, I can take on that question. So to be completely transparent, we definitely use AI in some of the validation of our assumptions as well as the model mechanics. So we won't deny that. However, However, we have built this model from the ground up using resources such as case studies, as educational resources, or even just financial modeling basics. So AI would have assisted us, but it would definitely not be in the driver's seat, is what I would say.
Okay, thank you. In terms of the case, where do you see the most sensitivity in terms of altering the share prices you've come up with?
Yeah, some of the most sensitive part. So wealth management is more stable, just chugging along with the AUM growth. The most sensitive part is definitely the cyclicality of the capital markets business, because this is heavily reliant on how many deals will get done in the Canadian market and how many deals can we capture within that market. And this is one of the more valuable segments in Newco. This will greatly impact the final share price, either from $45 up to $49.
Hey, thank you. And you see the two divisions here, investment banking and asset management. Just curious, maybe somebody else could respond. Where would you rather work?
I think that is a very interesting question. I was actually thinking about this myself a couple days ago, so very relevant. Depending on like myself and I guess lifestyle, if I want more of like a stable lifestyle and like not too much stress, I would go with like wealth management, because I know that it's not very like fluctuating, and it's very like it is, well, investment banking is relationship driven too, but it's not very like fluctuating. I'm not too worried about the interest rates and some of the other things mentioned in this case as well. But also, if I'm younger, I would definitely think about like investment banking, since it's like so high energy and there's like so much going on, if that answers your question.
Does anybody else want to take a stab at that question, or should we call it
Yeah,
done?
I'd love to respond to that question as well. Uh, I think wealth management, as mentioned before, very good place, very stable place to work. Obviously, being in the finance industry, there is a lot of work that you have to put into both categories. I think being young and having so much energy, capital markets would definitely be something that I would look into getting into. As I'd like to put that energy to use and really build myself up from the ground up at a young age. But wealth management is something I potentially look at in the future.
And
Aren't we missing an option here of valuations being your third option?
Sorry, I was baiting the question. Sorry about that. Bad judge. That's all I have for questions. Thank you.
Thanks so much, Mike. And with that, I believe we're done. Thank you, Team 16. Excellent job. You guys can hop out of the room, and yeah, great job. Judges, head on over to the breakout room, and you can begin your deliberations there.
Thank you, Kevin, and thank you,
Thank
Steam
you.
team.
Good
Thank you,
job.
everyone, for coming out.
Thank you so
having me.
much. Appreciate it. Thank you.
Uh-oh, I don't know if I can get to the breakout room.
Welcome, Team 30. How are you folks doing today?
We're doing great, and you?
I'm doing well, thank you. Well, have you been watching some of the presentations today?
Yes, we watched some of the presentations, yeah.
All right, so that's good strategy, picking up some helpful tips, perhaps. Love it. Why don't one of you go ahead and share your slide, your slide deck, so we can get started in 1 minute's time.
Hey Kevin, how's it going?
Good, how are you?
Very good.
Excellent. All right, gentlemen, you're free to start when you're ready.
Sounds good. Just need a minute. Hey everyone, we're Valuations LLP, and today we're going to be discussing the strategic alternatives for Crescent Oak shareholders. Now, moving on to the agenda, we're going to start off with the proposed merger with Pinnacle, then the buyout by Management LLC, then the share recap, and finally, our recommendation. I'll pass it over to Giovanni to start us off with the merger.
Before valuation for the capital markets division, we first calculate the WACC. For the cost of equity, we use a 4% risk-free rate, cost of equity and the given market risk premium and beta of 1.1, and 4% size premium appropriate for a $300 million market cap firm. For debt, we use the given pre-tax cost of debt and tax rate to calculate the after-tax cost. Then, applying the case's capital structure weights, our capital markets WACC comes to around 8.3%. For the wealth management division, we repeated the same framework, but with a lower beta of 0.9, reflecting a less risky division and a lower WACC of less than 8%. Now, for the capital markets DCF, so next slide, we built revenue from a $1 million base fee per IPO indexed to inflation, and additionally, a 2% performance fee on deal value, growing by roughly 4%. Next, compensation scales at roughly half the revenue. Cost of services steps up 5% in fiscal year 2026, then flattens because of a promotional effort until 2028 before tracking to inflation, and corporate overhead costs also rise in line with the inflation rate. Moreover, depreciation is $2.5 million per year, and working capital is held at about 4% of revenue for the valuation model. With those drivers set, we compute EBIT and then add back depreciation to arrive at the forecasted EBITDA. Next, we convert operating results to cash flow from EBIT to free cash flow to the firm. For the terminal period, we assume growth of 3% and value terminal value using the WACC. Additionally, we include the UCC tax shield using a 50% UCC and the given CCA rate by applying the rate of return adjustment with a 2.5% uncertainty rate. Finally, we add redundant cash while respecting the $10 million minimum that needs to stay within a company and deduct long-term debt using revenue breakdown between divisions, resulting in the capital markets FMV of close to $870 million. Now, for wealth management division, we also applied the capitalized earnings model because its economics are recurring and capital light. Specifically, revenues are 1.1% of ending AUM, capex is equal to depreciation, and working capital frictions are modest. Next, we normalize EBIT by reversing the lawsuit distortion, replacing the minus 49% realized on $10 million with the policy consistent plus 11% for return generated for 2025. Furthermore, to stabilize earnings, we present both a simple average and a weighted average, heavier in later years with 25% weight in 2024 and 60% weight in 2025. With capitalization rate of WACC minus G, we get a fair market value of around $34 million. So in summary, the capitalized earnings model fits wealth management because it has a stable and predictable stream of revenue generated through recurring investment management fees. Now for the wealth management DCF, we hold net flows flat, compound return generated at a historical return of around 11%, and keep distributions at about a 65% payout ratio. Additionally, operating expenses inflate in line with the case, and depreciation remains at $2.5 million. Then, we remove the lawsuit distortion from the return generated, so the forecast reflects normalized operations before we compute EBIT and then EBITDA. Next, we form free cash flow exactly as with capital markets by setting growth of 3% and calculating terminal value using the WACC. Again, we add the UCC tax shield of 50% and return cash and subtract that to arrive at wealth management's fair market value of around $170. Overall, this means value through AUM compounding rather than only today's earnings. Now, to frame risk, we performed a sensitivity analysis for the DCF of both divisions by changing the WACC and growth. In the most conservative scenario, so higher WACC and lower growth, for capital markets division, the implied FMV is around $550 million, which is consistent with the optimistic view of Crescent Oak's management team for the improvement of the CM division performance after rising interest rates disrupted its performance last fiscal year. For the wealth management, the most conservative scenario, the FMV is around $50 million, which is consistent with its stable but worse performance compared to CM division. Now for Pinnacle Wealth, we use precedent transactions and exclude three non-comparables for clear reasons. First, RoboCapital LLC, which is a robo-advisor AI model with low-touch service and software-driven economics. So basically, it doesn't match a human advisor wealth management platform. Second, Athena Capital Corp, which is concentrated in Asian equity markets, so it's very different from the US and Canada. And also, a Good Planet Investment LLC, which is an ESG-only mandate and is also focused on Europe. Next, using mean and median EV over AUM from the remaining transactions gives a robust range. Then we add Pinnacle's $80 million of cash and no debt to reach the FMV of close to $1.6 billion. Now for the merger, we model the synergies and discount them at the weighted average WACC of around 8% plus 2% incremental cost synergy risk. First, 10% savings on 2025 corporate overhead costs from India office consolidation, net of a one-time fee. Next, a 20% reduction in cost of services from scale on the combined platform for wealth management. Then we apply a $25 million non-capital tax loss carry forward against the CM net earnings before tax in 26. Then, using the discount rate of 10%, we get the final value for the PV of synergies of almost $39 million. Now, bringing it together, we weight the wealth management DCF at 60% and capitalized earnings at 40%. And we do that because AUM compounds by more than 10%, while costs grow mainly with inflation. So for cash flows deserve more weight. For the merger option, we apply an additional 35% minority discount in the FMV, since the subject shareholder, which in this case is Crescent Oak, would have an ownership greater than 1/3 of the company, so they'll be able to block a special resolution in a jurisdiction where at least 2/3 of the votes is required. Now, under that mix, the status quo FMV is around $66, whereas the merger is below 47. Now, I'll pass it back to Nias to finish our analysis for option 1.
Yeah, now moving on to the strategic considerations of the merger. Some advantages are it can be executed it can be executed quickly. And another one is that when we mix the capital markets division of Crescent Oak with the wealth management of Pinnacle, we'll have a much more balanced business overall. And moving on to the disadvantages, a key one is synergy uncertainty. A lot of times in M&A, these companies will overstate their synergies, which may not actually realize. And another one is the potential overvaluation of Pinnacle Wealth, because it was valued using the precedent transaction method, which accounts for a 20 to 40% control premium paid for by the buyer. Some more are shareholder dilution. The combined company, in the combined company, Crescent Oak will own less than a majority stake of the company, so they essentially lose control. And lastly, in these M&A transactions, a lot of times they do fail due to cultural challenges and in integration. Now, moving on to the buyout option, Management LLC proposed that they will give us $45 in total, $15 at the closing of the transaction, and $10 every year after until the third anniversary. And so looking at this transaction, we can see forecasting all the cash flows and then the days on top from how far it is from the valuation date. Now, to discount these future cash flows back to present date, we use the risk-free rate. For the $15 payment, we use the less than 1 year yield. And for the other 3 payments, we use the 3-year yield. And this is because once the transaction closes, these funds are essentially put in escrow, which makes them risk-free. And that's why we use the risk-free rate. And using this method, we get a share price of around $35. And we also accounted for a 70% probability that the share price would be the $40 here, and 30% chance that the deal does not go through and it remains the same $20 share price that we have right now. And moving on to the strategic considerations of the buyout, the key advantages are it's a cash offer. We know exactly what we're getting compared to a merger where it's just reliant on synergies and has that overvaluation of Pinnacle through the precedents. Another advantage is there's a low risk after closing. It's just these 6 months, and once the transaction closes, all the funds are in escrow and essentially risk-free from there. Another one is it's independent of synergies. We're not depending on anything else. It's pure cash. Now, moving on to the disadvantages of this strategy, the main one is the financing risk. If the sponsor doesn't receive financing, the deal can't close. Another one is a lower potential premium that we will receive on this deal. Because it is a financial buyer, they typically tend to be more price sensitive and pay less than strategic buyers who pay more in the 20 to 40% range. So we will essentially leave this premium off the table if we proceed with this option. Another disadvantage is the deferred payments. Majority of the payments will come after the deal close and are deferred. And these are the advantage and disadvantage of the strategic of the buyout. I'll pass it on to Azim to talk about the share recap.
Thank you, Niaz. Now, obviously, we're going to be moving on to the alternative share recapitalization option, which was the assumption that option 1 and 2 might not be viable. So first, we're going to start off by determining how many shares must be issued to achieve a target debt to equity ratio of 2 to 1, which also aligns with our industry average. For context, before any issuance, the company's net debt equity to ratio is approximately 20 to 1. It's important to note that $10 million in cash is excluded as redundant, since this amount must remain on the balance sheet as a minimum reserve. To determine the number of shares to be issued, we first calculate the target equity value of $132 million, followed by subtracting the current $15 million in shareholders' equity. That gives us the new equity required. At an issue price of $18 per share, we find that approximately 7.33 million new shares to be issued, bringing the total outstanding shares to 23.33 million. Lastly, when calculating the fair market value per share under this alternative, we build upon Giovanni's DCF analysis with the adjustments for the new capital. The $132 million cash inflow increases total equity value, which is then partially offset by the dilution from the 7.33 million new shares, thus resulting in a fair market value per share under this option of $49.96. Next, we analyze the earliest date dividend can be reinstated, supported by a sensitivity analysis across 3 scenarios. The company's dividend policy specifies that the dividend payout ratio must remain below 90%. In scenario 1, which we can call our base case, the cash raised from the share issuance is not used to pay down debt, but rather to keep on hand until the end of the forecast period of 2030. We begin by calculating the cash flows available for distribution for both the capital markets and wealth management divisions. EBITs for each divisions come from the previously mentioned DCF forecast. Interest expense remains fixed at $24.5 million starting in 2025, since the company is already at its maximum debt level, and this amount of $24.5 million is allocated respectively 38.6% to capital markets and the remainder to wealth management. Taxes of 20% are applied to each division. CapEx is calculated net of tax shield, and change in working capital comes directly from the DCF model, with the wealth management constant at 0. We then subtract all these items from our EBIT to arrive at our individual cash flows available for distribution. Next, we calculate the dividend payout ratio. The dividend per share is $1.89, reflecting the 5% annual increase from 2024, contingent on maintaining a payout ratio below 90%. Multiplying this by the new 23.33 million shares outstanding and dividing by the total cash flows available for distribution, we can find a payout ratio of 81.29% in 2030. Therefore, under this first scenario, you can say that dividends could be reinstated in 2030 into 2031. In scenario 2, we introduce a sensitivity case where the cash raised from the share issuance is immediately used to pay down debt. The structure of the analysis remains largely the same, except now the interest expense includes principal repayments. In 2025, both the interest and principal payments are significantly higher, reflecting the $132 million debt repayment split equally between the two divisions. After this repayment, the remaining debt is $218 million with an interest recalculated at 7%. This results in a lower interest expense in subsequent years as the debt balance declines. Under this scenario, the lower interest burden allows for the company to reintroduce dividends 1 year earlier in 2029 with a payout ratio of approximately 85%. Therefore, dividends should be reinstated in this year, followed by 5% increase into 2030. Next. Finally, our final scenario, scenario 3, is very similar to scenario 1, in that the cash inflow from the share issuance is not used to pay down debt. However, instead of keeping the cash idle, it is invested to generate additional income. Specifically, we assume the cash flows available for distribution are invested in a 3-year T-bill yielding 3.6%, and that the $132 million raised is also deployed to generate investment income. This additional income enables the firm to reinvest dividends or reintroduce dividends 1 year earlier in 2029 with a payout ratio of 89.45%. Upon this, the company can then liquidate these investments the following year to fund the ongoing dividend payments. To conclude our analysis of the alternative share recapitalization option, we will talk about the key advantages and disadvantages. Firstly, for the advantages, it strengthens the balance sheet by reducing the debt to equity ratio to industry standards. It improves financial flexibility and reduces interest expenses, and it positions Crescent Oak for sustainable long-term growth and supports reinstating its dividend policy. For the disadvantages, it requires issuing new shares at a 10% discount, which dilutes current shareholders. Dividend reinstatement will be delayed until later in the forecast period, as we just saw. The equity raise may be difficult to execute if investor sentiment still remains weak, as it currently is, and it provides limited immediate value, unlike the merger or buyout options. Now that we're done with that, I'll pass it back to Nayaz.
Now, moving on to the final recommendations. Out of all the options we analyzed, the best course of action is to not proceed with any of them right now, and instead focus on organic growth. However, rather than relying on gradual growth of the capital markets and wealth management divisions, we recommend a more strategic approach, which is a deferred divestiture of the wealth management division. So, in which, well, we're going to wait 3 years to sell the wealth management division. This is because right now, the stock is at an all-time low, and we are going to tank investor confidence even lower. Instead, we wait 3 years till the IPO market picks up, and we can advise on more deals. Then we can sell at a higher valuation and potentially earn a higher control premium if we sell to a strategic buyer. Once we sell the division, we can focus on expanding into other investment banking services like debt capital markets and M&A advisory. Because right now, we only focus on equity capital markets, and this puts all our revenue at risk because it's heavily dependent on the IPO market. Now, let's take interest rates, for example. If interest rates rise, IPO markets slow down, M&A and DCM as well, but there's still an opportunity for restructuring and distressed M&A activity. If interest rates drop, IPO market and the M&A deals pick up strongly, and DCM is active. This diversification will allow them to gain a higher market share in the overall investment banking services and become a more well-established investment bank. To conclude, we believe that the shareholders of Crescent Oak should consider a deferred divestiture of the wealth management division. Thank you all for watching, and we're open to any questions.
Yeah, great work on the presentation. My first question is, if you go back to the wealth management division, so the sum of the parts analysis, I believe, you decided to use a weighting 60% on DCF wealth management and then 40% for capitalized cash flow. And so 2 components here. So first, I'm interested in if you could provide some insight on why you think there might be such a difference between the valuation from those approaches? And then second, how you ultimately decided on the weighting breakdown.
Yeah, that's a good question. So first for the difference of the numbers. So basically for the DCF, we're also accounting for a higher return of 11% for the return generated for AUM. And the second reason is also the lower WACC compared to other firms because it's a very less risky division. So basically having a lower WACC, you have a lower PV factor, a higher PV factor. So basically you get a lower discount of the numbers as well, so a higher fair market value. And also for the weight, so basically we decided to allocate a higher weight for DCF because the company was expecting higher returns for the wealth management division. So basically, that's why we decided to allocate a higher weight of like above 50%, so 60-40. So yeah.
Yeah, that's helpful. And so currently the market share is, so the share price in the market is $20 versus much higher intrinsic value as you calculated. So I wanted to get some of your thoughts on why there might be this pretty substantial discrepancy between that like market price versus the actual fair value.
Yeah, so the two main reasons is that the IPO market isn't doing so well right now, and they advise on a lot fewer deals. So the capital market isn't doing too well. And second, the wealth management division was actually had a lawsuit from an investor. So those are like the two main reasons why
And
it's
the other reason is also that the company wasn't able to pay dividend. So that's why it had a drop of like 60%, as the case mentioned as well. So it's more like a reaction from the public market, from the news, instead of internal like operations thing as well. So
Yeah, thanks.
sure.
Hello, Team 30. Good to see you again today. So I have a couple of questions relating to your new recommendation of the divestiture of the wealth management division. I guess I'll ask a couple questions and you can answer them maybe one at a time. So my first question is how you came up with this as a potential recommendation to provide to the committee. And the second would be what impact do you think this divestiture would have on the capital markets portion of the business, considering that the wealth management was sort of the stable portion of the business that really offset the highs and lows of the capital markets?
For sure, yeah. So when considering of why we should sell it, the main reasons were that it was a lot lower margin compared to the capital markets division. The costs were a lot higher. And second, it was also recently sued. And so that essentially hurts like our brand name and shows that we're not really capable of investing on behalf of like investors, like limited partners. So those were the reasons why we thought it'd be better to sell and go into capital markets. And in capital markets, we had a 10% market share already. And could I get the second question again, please?
My question was how you thought it would impact the capital markets segment of the business by selling this, considering there are, cash flow reasons that this balanced it out, but also possibly cost sharing between the two divisions that might change the cost structure for capital markets on a standalone basis.
So we knew that the wealth management was a lot more stable and had stable cash flows. And I believe for this company, the reason why capital markets was a lot more volatile was because they only did equity capital markets, which focused solely on the IPO market. So if the IPO market is doing well, then they're making money and they're getting the revenues. If it's not, then it completely tanks. And so our idea was to diversify, have that stable revenue, which comes through other investment banking services, which are M&A and debt capital markets. Because regardless how conditions change, if, for example, the IPO market isn't doing well, then debt capital markets could make up for that portion. And in that way, we'll have a much more stable business. And also, in another thing we consider was in investment banking, the cost, like the salaries that we have to pay to our employees, is a lot higher. And so being able to incorporate debt capital markets and M&A into it, we can essentially get economies on scale on that.
I just wanted to add a bit to the first question there, Nayaz. If you go to the next slide, sort of where this idea initially came from, one more down. Yeah, this one. So if we look at or in scenario 1 and 2, you can see the wealth management cash flows available for distribution. And you can see that in our base case, let's say cash isn't used for anything and just sitting idle, you can see that cash flows available for distribution are negative all the way from 2025 until 2029. Now we get that, like as Nayad already alluded to, that it's like the stable cash flow one. It kind of like provides cash flows for us to operate into other segments as well, like our capital markets division. But looking at this negative cash flow available for distribution for 4 out of the 5 years that were forecasted, that sort of, I guess, pushed us into this alternative reasoning. And you can also see, if you go to the next slide as well, it's negative until the same point, 2029. And we thought, I guess the reasoning behind this would be that our money could be used better elsewhere. And then not going into all the details that I just said, but that was, I guess, the main reason why we shifted towards, maybe selling this division.
And I guess I just ask one follow-up question then, and that's that I noticed that the interest payments and therefore the debt was allocated between the 2 divisions. What basis did you use to allocate the debt between the 2 divisions? Was it based on just revenues, or was it based on capital requirements? Where did that come from?
Yeah, so if you go back one slide, here. So the interest payments for the debt, there was, I believe, a revenue breakdown that we had calculated. And what it was we tried to find how much, I guess, revenues were coming for our total revenues. And what we did was we pretty much allocated this to our interest expense. So initially in 2025, our interest expense was 24.5 million. And because we were maxed out at our debt on the time, we assumed that this would stay constant. And the way to split up the debt equally, it wasn't 50-50. The way we did it, I believe it was 38.6% or 38.5% for capital markets, and the rest to wealth management. And the main reasoning for this was just, again, like the revenue breakdown. We wanted to make sure that the interest payments were reflective of each department respectively, mainly because we did do 2 different cash flows available for distribution, and to make sure that was accurately reflecting. Because it would definitely be unfair to the wealth management division if it was 50-50, and then the negative would go much more into the negative, and it would just be a lot harder to overall, visualize the numbers.
Okay, great. Thank you.
Thank you for the presentation. I did have a couple technical issues, but I definitely caught a good chunk of it. So sorry about that. But yeah, just as I also had a question about your recommendation. So I thought you said that you would wait 3 years.
Yeah.
What was the reason for that, I guess?
Yeah. So the reason behind that was because right now our stock price is already at $20. And at this point in time, wealth management is known as the stable revenue producing division. And right now, capital markets isn't doing so well. So if we just decide that, okay, we're going to sell our wealth management division right now, it'll just tank the stock price even lower. So we thought it'd be better as the IPO market picks up and the wealth management division continues to grow, then we can potentially also sell the company at a higher valuation and get higher proceeds from that.
Okay, so you're saying wait until the capital markets, industry just picks up in general.
Yeah. Also in terms of investors, we would react better for the short price. Yeah.
Okay. And then I know Curtis already asked a question about the income approach, or sorry, the DCF and the capitalized cash flow being used for the wealth management, but I wasn't sure. Did you guys kind of talk about why you selected, like, for example, like the DCF for the capital markets division, but then you use the 2 approaches? Like, what kind of went behind the methodologies that you picked?
Oh, so basically, we decided to also use the capitalized earnings model for the wealth management division because it's basically because the capital expenditure is approximately equal to depreciation, and also because like it's a very like stable business. So basically the growth rates they basically just flow with inflation as well, and very constant. So that's why we decided to choose not only the DCF but also the capitalized earnings for wealth management. But for the capital markets division, it's more like growth oriented. So that's why we only used DCF for that.
Okay, thank you.
Thank you for the presentation. I really appreciate it. Just wondering, with respect to the research you've done and sort of outside the case, what you've done, and is there anything else you would do if you had more time?
Yeah. So I would say if we had more time, the one thing we would do is actually like look into sorry about that. If you look to the final recommendation, yeah, so this slide right here, what I would do is essentially forecast how we would go about building into debt capital markets and M&A advisory. And what I got to in what I realized was capital markets, there tend to be a lot of more transferable skills because it's a mix between like the market and the deals. So for debt capital markets, we could actually essentially build that in-house and hire like a team for that. But we have no experience with M&A advisory, and that's where we might want to use the proceeds from the divestiture to essentially acquire like a M&A firm and essentially have that be our M&A platform. So yeah, if I had more time, I'd essentially forecast how the debt capital markets and M&A advisory divisions would like look in the near future.
Thank you. The IPO markets picked up in the US. Do you have any kind of thoughts as to why it has? Yeah.
In the US.
I mean, the first thing is definitely the decrease in interest rates. Yeah. Do you want to add us on that?
Anything else?
On top of my head, I don't know
I
exactly.
mean, in the US, it's also like I think the US president is also like very patriotic as well. So basically, it's also like adding some investments into the US as well, like protecting the US assets. So that's another reason. Yeah.
Yeah, and just to add to that, yeah, don't keep up, haven't been keeping up the markets too much recently. But one thing I saw was I believe tech has been like driving the S&P recently, if I read that somewhere. And Nvidia, I believe, launched like some interesting partnerships as well.
Okay, thank you for that. I guess last question for today. How did this team get together to be a team for this challenge?
Yeah, for sure. So initially, I was planning on doing the case competition team with a friend from York, and we realized that we couldn't do it from from different schools. And that's when it was like right on the deadline. And I just reached out to our investment club that I'm part of. And I was like, hey, this CBV challenge is coming up. Does anyone want to like do it? And both Giovanni and Azim sent me a message, and I was like, yeah, let's do it.
Okay, great. Let's do it. Like Nike. Thank you. Have a great day.
Thank you, guys.
Thank you.
Great. So it sounds like the questions from the judges are complete. So thank you, Team 30. Excellent job today. I know it was tough to probably wait till the end of the day to get your crack at this, but you guys did really well. So just a reminder that we'll be announcing the results at 7:30. So make sure to tune into that live stream. And otherwise, have yourselves a lovely evening.
For
Yeah.
sure.
You as well. Thank you.
Thank you very
everybody.
much. Have a nice
Take a day.
evening.
Bye.
Thank you, guys.
Bye.
Thank you. Bye.
Hey, Maheen or Kevin? I can't see my video.
I don't want to appear on the live stream. Good evening, everyone. It's the moment we've all been waiting for. Welcome to the closing remarks and award ceremony for CBV Institute's 2025 Business Valuation Challenge. My name is Kevin Flother, and I'm the Director of Marketing and Communications for CBV Institute. It's my pleasure to welcome you here today. We are on our fourth year of this case competition, and we have witnessed year-over-year growth and participation from undergraduate students from business schools across the country. This year, we had 30 teams and 103 students from 18 different schools register for BV Challenge. On behalf of CBV Institute and our network of business valuation professionals, I would like to once again congratulate this year's participants. The caliber of your analysis and your professional presence has impressed the judges to no end. In particular, congratulations go to the 6 teams who proceeded to today's final round. I would now like to pass it off to Dr. Christine Sawchuk, President and CEO of CBV Institute, to announce the final results of the competition. Christine, over to you.
Thank you, Kevin. And now it's my great pleasure to announce the first, second, and third place BV Challenge 2025 award recipients. By way of reminder, the third, second, and first place teams will receive $2,500, $5,000, and $10,000 respectively. Okay, moment of truth. In third place, we have Ryan Enns, Gurleen Mengat, and Aaron Reed, representing the University of Calgary. Congratulations, Ryan, Gurleen, and Aaron. And in second place, we have Muskan Agarwal, Sabrina Cho, Cedric Furman, and Leah Lau, representing the University of Toronto St. George campus. Congratulations, Muskan, Sabrina, Cedric, and Leah. And finally, the winner of BV Challenge 2025 is Maya Bazubiak, Kainwyn Clark, and Alan Solomon, representing the University of Alberta. Congratulations, Maya, Kainwyn, and Alan. On behalf of CBV Institute, congratulations to our top teams and all the participants this year. A quick note to our top 3 teams before we finish. A member of the CBV Challenge team will be in touch soon via email to discuss next steps. And now we close the door on BV Challenge 2025. Thank you to all the students representing business schools from across Canada who accepted our challenge, our esteemed panel of judges who volunteered their time and expertise, and of course, our sponsors who stepped up to support our 3rd annual business valuation case competition. Your efforts and dedication have exceeded our expectations, and we're already looking forward to our next challenge in 2026. Thank you, everyone, and have a wonderful weekend.